Good morning, ma'am.
Morning.
We are streaming live now.
Okay. Can I start then?
Yes, yes.
Welcome back. So let us start the next session. Today we will be discussing about profits and gains of the most important chapter, profits and gains of business or profession. The provisions of business income are contained in section 28 to section 44D of Income Tax Act. This is a sections, it's a pretty huge chapter. Section 28 to 44B is that provisions, a chapter of income tax, which deals with profits and gains of business or profession. So let us first see section 28, that any chapter or any head of income starts with basis of charge. So let us first see, as per section 28, what is basis of charge and what are the conditions to charge an income under the head business. When do we call an income as business income as per section 28? The first and foremost item which is mentioned there is profits and gains of business or profession. The term business has been explained as any trade, commerce, or manufacturing. Business is defined as trade, commerce, or manufacture, or it can be any adventure in the nature of trade, commerce, or manufacture. And the term profession has not been defined in Income Tax Act. It only says that profession includes vocation. Profession includes vocation. So anyway, what do you mean by vocation? Anything which is done as a pastime or a hobby with no intention to make profit will also be taxed under the head profits and gains of business or profession if at the end of the day you make profit. So the intention need not be there. Intention to make profit need not be there. Even otherwise, when you make profit from any transaction, that will be treated as profits and gains of business or profession. So that is the first item which we have to discuss here. Profits and gains of business or profession is taxed under this head. Okay, profits and gains of business or profession. The second item which we tax here is compensation received. Compensations received are also be taxed under this head. And this compensation might be received when it can be received on termination or modification of any contract relating to management of affairs of a company. See, a person was a manager in a company, and also let us just assume that this person was not an employee. There was no employer-employee relationship between the payer and the recipient. And the recipient was managing the affairs, and his contract with the company was terminated or it was modified. And at the time of termination or modification, he's given some compensation. That compensation will be taxed as business income, even though that is a capital receipt. Even though that is a capital receipt. Second point is, a person had been carrying out an agency business in India, and that agency business is also terminated, and some compensation is received on termination or modification of that agency business. Then again, that compensation received will be taxed as business income. Okay. any compensation receipt or termination or modification of the business activity. Let us take an example. I had an agency of like Hindustan Unilever Limited. Okay. I was an agent of Hindustan Unilever Limited. I have a shop in Chennai that sells their product. One fine morning, they are call me and they are telling me that they don't want to continue the agency in Chennai. And they are offering me a compensation. Since the agency business in Chennai is closed, they are offering me a compensation of around 10 lakh. The 10 lakh received by the agent will also be taxed under the receipt, again, even though there is a capital receipt. So point number 2, we are talking about capital receipts here. Point number 3, any contract relating to the business, is also terminated. Then any contract like I had entered into a contract with an architect. The architect had promised to complete construction of a property by March 31st. That was the period of contract between me and the architect. He is constructing a building for me, an office building for me. And the contract, as per the contract with the architect, the construction would be completed by 31st March. He couldn't complete the construction by 31st March, and I demanded some compensation from the architect. That compensation received will also be taxed under this head. So under point number 2A, we are all talking about capital receipts. Even though that is a capital receipts, the compensation received under these 3 cases, that is either there is a termination of management of affairs, or there is a termination of agency business, or any contract relating to the business is terminated, it will be taxed under this head. Point number B, the management of the business is taken over by the government, and the government is offering some compensation. Even then, that will be taxed under this head. So point number 1, what we are talking is the revenue receipt relating to profits and gains of business or profession. And point number 2, any capital receipt related to business falling under A and B. A, there are 3 classifications. B, there is 1 classification. Even though that is a capital receipt, that will also be taxed. Now, point number A, B, C, D, and E talks about export incentives. Point number 3, there are 4 classifications, A, B, C, D, and E. This talks about export incentives. Usually, the exporter, since he is contributing to the foreign currency of the country, exporters are usually given a lot of incentives by the government. The first one is, I'm talking about point number 3B. It is a cash assistance. Commonly, we call it as subsidy. Any subsidy which is received by the exporter will be taxable. Subsidy, okay? It is cash assistance. The second one is 3C. I'm talking about 3C. It is duty drawback. Duty drawback. That is any duties, taxes which you have already paid to the government will be given as refund. That is what is called as duty drawback. You can take back the duty which you have already paid. So point number 3B is subsidy. Point number 3B is subsidy. Point number 3C is duty drawback. And how about point number 3A, 3D, and 3E? 3A, 3D, and 3E says that where a person has sold some of the documents relating to export import, like exempt script, duty entitlement passport scheme, duty replenishment certificate. At the intermediate level, you need not know what is the objective of all these. But anyway, when a person engaged in export sells these types of certificates or these types of licenses, it can be exempt duty entitlement passport scheme or duty replenishment certificate. Profit on sale of these 3 certificates will be taxed as business income. Why this has been specifically mentioned here is because normally when we sell some sort of asset, we think about capital gain, is it not? We charge that profit under the head capital gain. But an exporter, if he sells these 3 types of scripts, that is 3A, exempt script, 3B, duty entitlement passport scheme, 3D, and 3E, duty replenishment certificate, the exporter, when he sells these 3, it will be taxed as business income. Okay, so that is point number 3, A, B, C, D, and E. Point number 4, a person carrying on business is receiving some benefit or perquisite from his clients or from his dealers or from his suppliers, any person, during the course of business or profession, he is receiving some benefit or perquisite. The benefit or perquisite received by a person engaged in business or profession will also be taxed under business. The same way we tax the perquisite received by a salary class under salary, perquisite received by a businessman will also be taxed under business income. So think about an auditor. Auditor, when he audits an organization and receives something in kind, like if he is auditing a jewelry shop, he is receiving some jewels as audit fees. He is receiving a necklace as an audit fees. That amount of the money value of the necklace is to be added to his audit fee income. So that is the fourth point. Point number 5, any amount received by a partner from a partnership firm, no matter how you call it, like salary received by a partner, commission received by a partner, interest on capital received by a partner, anything received by partner from a partnership firm will also be taxed under this head, business. Then, point number 5A. Point number 5A. Any sum received under an agreement for not carrying out any business activity or for not sharing any know-how is also taxed as business. See, generally we receive money for doing something. Is it not? Generally, I receive money for carrying out audit. For carrying out audit, I'm performing something and I'm receiving consideration. Here, I'm not doing anything. I'm just sitting idle. Even then, I'm receiving money. Some receive for not carrying out business activity, like we'll call that normally as non-competency fee. Non-competency fee received, even though there is a capital receipt, or for not sharing any know-how, patent, copyright, etc., that will also be charged as business income. All right. Point number 6, Keyman insurance policy. Keyman insurance policy is a policy which is taken by the employer on the life of an employee who is an important person in this organization. Okay, the word itself, key man, means important person. So the employer has taken an insurance policy in the name of employee. Okay, employee is receiving some compensation that will be taxed as a salary income. If there is no employer-employee relationship, like a partnership firm taking a Keyman insurance policy in the name of partner. Partnership firm taking a Keyman insurance policy in the name of partner. Partner is not an employee of partnership firm. We all have learned that partner is an agent of a partnership firm under Partnership Act. So there is no employer-employee relationship. Now the compensation received by the partner for a Keyman insurance policy, so cannot be called as salary as he is not an employee. Then that will be taxed as this business income. Okay. Now, suppose this person dies, either the employee or the partner dies, and the amount is given to the family members of the deceased person, then that will be taxed under the head income from other sources. That is regarding Keyman insurance policy. Same policy, there are 3 tax treatment depending upon in whose hands the policy is maturing. If the policy is maturing in the hands of employee, it will be called as a salary. The policy matures in the hands of person who is not an employee, then that will be called as business. If the policy matures in the hands of family members, that will be called as other sources. Okay, point number 7A, there is a conversion of inventory into capital asset. There is a conversion of inventory into capital asset. Imagine a situation where I am I'm a car dealer. Okay, I'm a dealer of Maruti cars in Chennai. What happened is, few of the Maruti cars that arrived in my showroom today, I took 2 of these cars for the purpose of my business. I converted my stock as my asset. I took 2 cars, and these 2 cars are used for the business purpose. That is for the purpose of transport of employees or for the purpose of transport of director. The director is using the car which belongs to the company. So it is an asset. It is not meant for resale. It is not meant for resale to the customer. We are using that in the business itself. That conversion of inventory into capital asset will also be treated as business income. All right. Point number 7. Any sum received on a capital asset on which deduction has been claimed under 35AD. We'll deal with that later. 35AD will be seen shortly. So let me keep that item in pending. And the last item which we have to track here is income from speculative transaction. Income from speculative transaction. Speculation is a transaction which is settled otherwise than by actual delivery of the product. Only the money involved in that transaction is circulating. Let's take a share trading transaction that normally happens in shares. I ask my broker to purchase a share for 100 rupees in the morning, and in the evening, when the price reaches 110, I ask him to sell it. Morning, I need not transfer 100 rupee. Evening, I won't get 110. I get only the 10 rupee profit credited in my account. Moreover, the share is not registered in my name. Share is not registered in my name. Okay, the company never transfers the share certificate into my name, and that is what is called as a speculative transaction. So, speculative transaction, normally it's a transaction which is settled otherwise than by actual delivery of the product. So, these are the 8 items. These are the 8 items that is to be taxed as business income. Okay, 8 items that is to be taxed as business income. So let us recollect what are the items which are to be taxed as business. What are the items that are to be taxed as business? The first item which is to be taxed under the head business is profits and gains of business or profession. Okay, profits and gains of business or profession. The second item which is to be taxed here is compensations received. And this compensation might be received on termination of a contract. And this contract might relate to management of affairs of any company, agency business, or any contract relating to business. And there is also a compensation received on vesting of the management of business or property in favor of government. Okay, that is point number 2. Point number 3 is all about export incentives which are received by exporters. It can be in the form of cash assistance, duty drawback, then profit on sale of some licenses. Point number 4, any benefit or perquisite received during the course of business or profession, that is also to be taxed as business income. Point number 5, anything received by a partner from a partnership firm, that is business income, whether you call it by the name salary or interest or whatever. Any sum received under an agreement for not carrying out any business activity or not sharing any know-how or patents, that is also taxed under this head. Point number 6, sum received under a Keyman insurance policy, but the recipient is not an employee, then that will be taxed as business income. Conversion of inventory into capital asset, that is inventory has been inventory sold from business in some other form, that is also taxed as business income. 35AD we'll discuss later. And income from speculative transaction, a transaction which is settled without delivery of the product, that is also taxed under the business. This chapter on profits and gains of business or profession. Some accounting knowledge is required because the method is the same. Like method is almost the same. We prepare a P&L account and we arrive at the net profit. So that basic accounting knowledge is required while we are doing problems from business. But for other heads of income like salary and house property, this accounting knowledge is not required. Okay, so let us see what are the conditions, what are the basic accounting principles for arriving at the business income. The first point is business shall be carried on by the SSC. Okay, business shall be carried on by the SSC, which we all know. Second point, business shall be carried on during the previous year. Only a business which is carried on the previous year is taxable in the following assessment year. Point number 3, tax incidence is in respect of all businesses put together. What does that mean? I have 2 businesses, business A and business B. From business A, there is profit, and from business B, there is loss. I will add both business A and B together to arrive at business income under this head. Of course, there are some exceptions. Point number 4, in certain cases, beneficial owner will be taxable in the place of legal owner. Beneficial owner is taxable in the hands of legal owner. There is something called as pre-incorporation profit. Okay, I think you have a separate chapter on pre-incorporation profit in accounts. So there is something called as pre-incorporation profit. Now, what is this pre-incorporation profit? A company that was incorporated only on July 1st. Okay. The certificate of incorporation was received on July 1st. But the company started its commercial transactions maybe by June 15. There was some trial run that was done and some product was manufactured, which was sold. So the company has got two profits. One is before incorporation and the other is after incorporation. We all know that the company is not existence in the month, not existing in the month of June. It is not in existence in the month of June because the company got incorporated only in July. And June, the company is earning some profit. That profit we call pre-incorporation. When we talk about purely in the technical way, the owner of the pre-incorporation profit is the promoter, because promoter was the person who was doing this business in June on behalf of the company. But the promoter is not doing this business for his own personal benefit. He is doing this for the benefit of the company. So the owner of, let me use the term beneficial owner. Beneficial owner of the pre-incorporation profit, beneficial owner of pre-incorporation profit is the promoter, is the company, though the legal owner is the promoter. Okay. Regarding pre-incorporation profit, the beneficial owner is the company and the legal owner is the promoter. The profits, pre-incorporation profit will be taxable in the hands of company and it is not taxed in the hands of promoter. It is not taxed in the hands of promoter. Okay. So that is an example of when will a beneficial owner be taxed in the hands in the place of legal owner. Point number 5, anticipated profits or notional profit are not taxable. This is the same which we follow in accountancy, principle of prudence. Anticipated profits are not to be taken credit of. Anticipated profits are not to be taken credit of. That is the reason why we value closing stock as on 31st March at cost and not market value. We might be knowing that this entire closing stock has been sold on April 5th. Entire closing stock is sold on April 5th at a huge profit. Even then, on valuing, at the time of valuing closing stock on 31st March, we value it at only cost price. We don't take the market value. That market value or the profit which you have enjoyed in 5th April stands only in 5th April, not on 31st March. Okay. So anticipated profits or notional profits are not taxable. Point number 6, method of bookkeeping can't override nature of transaction. The way you have recorded a transaction is not relevant. What would the Income Tax Act look into is the nature of transaction. Like, let me give you an example. There was revenue receipt. You have received some rent. When you receive rent, the journal entry that we have to pass is cash account debtor to rent or bank account debtor to rent. Is it not? And the rent has to be transferred to the income and expenditure account or the P&L account or whatsoever. Cash account debtor to rent. But what the organization did is they recorded a journal entry, cash account debtor to Mr. A. Cash account debtor to Mr. A, and Mr. A was taken to the balance sheet. Okay, so the revenue receipt has been recorded as a capital receipt. What the Income Tax Department will consider is the basic nature of transaction. The department will not accept the way you have recorded it. Okay, so method of bookkeeping can't override nature of transaction. We give more importance to the nature of transaction rather than the method of bookkeeping. Point number 7, there is no distinction between legal business and illegal business. In legal business also, if you earn any profit, you have to tax it. So these are the basic principles for arriving at business income. Now, there are two heads of income where the method of accounting is relevant. Salary, there is no method of accounting. House property, there is no method of accounting. Capital gains, there is no method of accounting. But there are two heads of income where the method of accounting is relevant. Accounting principles are relevant. That is, one is business, of course, and the other one is other sources. So as in the case of accountancy. Here also there are two methods of accounting. One is cash system or mercantile system. You may use either of these, cash system or mercantile system, but once a system is accepted, that has to be consistently followed. Once you choose an accounting system, once you decide that you are going for cash system, in all the forthcoming years, you have to follow that cash system only. But there are two incomes which are taxable only on receipt. Only when you receive money, you have to tax it. There are two incomes which are taxable only on receipt. One is interest on enhanced compensation. Interest on enhanced compensation. That is, there was some compulsory acquisitions done by the government. You were not satisfied by the amount of compensation that was received by the government. You filed a case against the government for recovery of extra amount. And along with that extra compensation, you were given interest for the delay as well. That interest portion is taxable only in the year of receipt. Subsidy or grant received from government is also taxable only when it is credited in your bank account. Okay, so these two items, even if you are following mercantile system of accounting, this is taxed only in the year of receipt. Now we will come to deductions. See, as in the case of salary and as in the case of for house property, there is no strict format for computing profit under the head business. There is no strict format. The only thing which they have mentioned is any expenditure related to the earning of the income, any revenue expenditure, of course, related to the earning of the income can be claimed as deduction. Even though there are a few specific deductions which have been explained, there is finally a general deduction, a general section which says that any revenue expenditure related to the earning of the income can be allowed as deduction. So there is no strict format as in the case of salary or house property. We all know that salary, there were only 3 deductions, is it not? Standard deduction, entertainment allowance, professional tax. In a house property, there were again only 3 deductions, municipal tax, standard deduction, and interest on loan borrow. But here it's not like that. We can claim any revenue expenditure which is exclusively related to the earning of the business income. So we have to identify what are the possible deductions, what are the items, if you think about a P&L account, what are the items which can be deducted in P&L account before we arrive at net profit? Okay, what are the items that we are going to debit in the P&L account before we arrive at the net profit? And those deductions are given under section 30 to 36. Okay, deductions are given under 30 to 37, like 30 to 37. Of this 30 to 36 are specific deductions. 30 to 36 are specific deductions and 37 is the general deduction. Okay. 30 to 36 are specific. They have named it. Each and every item they have named. What can be claimed as deduction under 30? What can be claimed as deduction under 31? They have mentioned specifically what are the deductions. And any item which don't fall under 30 to 36, items which do not fall under 30 to 36, but which is related exclusively for business, can be claimed as deduction under section 37. For example, salary. Salary we claim deduction under 37. It's not specifically given under 30 to 36, but we very much know that salary given to employee is very much allowable. Then another example is traveling expenditure. If anything related business travel can be claimed as deduction here. All your office expenses can be claimed as deduction here. So 37 is the general deduction. Any other expense which is related to business will be allowed as deduction under section 37. 30 to 36 are the specific deductions. Okay, specific. So let us see one by one what are the deductions that are possible under section 30 to 37. There are 22 items in your syllabus, 22 deductions which are possible. Intermediate level, we discuss only with this 22 deductions. Items, we are identifying the items which can be debicted in P&L account. Okay, items which should be debicted in P&L account. The first item which can be claimed as deduction under section 30 is expenditure related to building. Expenditure related to building. What are the possible expenses related to building? What are the expenses that might be related to building? See, it's an office building. I might be paying rent. I might be paying insurance. I might be paying municipal taxes, rates, okay, repairs. All these are expenditure which are related to an office building, rent, rates, taxes, insurance, and repairs of the building. Similarly, there will be a lot of machinery and furniture in office. So if you have taken all those machinery and furniture on rent, you are incurring expenditure by way of rent, insurance, repairs. Okay, this is also allowed as deduction. Anything related to building, anything related to machinery, plant, and furniture. Now, in both these cases, we have used the term rent. For both building and machinery, we had used the term rent. That is, if you have taken all these on hire, then we will be claiming deduction for rent. What if you own the building and you own machinery, plant, and furniture? You own the machinery instead of taking it on hire. You own the building, you own the machinery, you own the furniture. In that case, there is another extra deduction which we have to claim, that is called as depreciation. Okay, another extra deduction which we have to claim is called as depreciation. So let us see what are the conditions for claiming deduction by way of depreciation. Okay, what are the conditions for claiming deduction for depreciation? There are 4 conditions in order to claim deduction for depreciation. There are 4 conditions. First condition is that depreciation is available only to the owner of the asset. Owner of the asset. However, there are 2 exceptions where a person who is not owner can claim deduction. We'll come to that. So the first point is depreciation is available only to owner. Second is the asset for which you are claiming depreciation that shall be used in business. Okay, usage is important. Usage. Third point, that asset shall be used in the previous year. Only then depreciation can be claimed for the assessment year. And depreciation is available on both tangible asset as well as intangible asset. So these are the 4 conditions in order to claim depreciation: owner, usage, previous year, tangible and intangible asset. Now let us see what are the exceptions. Exceptions were a person who is not owner can claim depreciation. A person who is not owner can claim depreciation. One is in the case of hire purchase. We know that a hire purchaser, he becomes the owner only upon payment of last installment. Only upon payment of last installment. But this hire purchaser has been using this asset for his business from the first year itself, upon payment of down payment. When you pay the first installment, immediately when you sign the contract and you pay something that is called as down payment, and you get the possession of the asset on making down payment, then you are using it for the purpose of business, but you are not owner. You are owner only upon payment of last installment. That is only a technical delay. So you can claim depreciation even from the first year onwards, right from the first year onwards. So that is a hire purchaser. He is a person who is claiming depreciation even if he is not owner of the asset. Second one is, you have taken the building on rent. A building has been taken on rent and you are incurring capital expenditure on that building. Capital expenditure on that building is incurred by you. Even then, you can claim depreciation. Okay. So SSC who has taken a building on rent and as he has incurred capital expenditure on such building can also claim depreciation, and depreciation is compulsory. There is no option. Even if you have a loss, you have to charge depreciation in the P&L account. So depreciation is quite a big area. We'll see, we are still in depreciation, we are still in section 32. let us further see what are the three terms that are required for charging depreciation, because we have to get familiar with these three terms before you calculate depreciation. Let me first explain what is block of asset. I'm explaining this term, block of asset. Block of asset means similar asset having same rate of depreciation. Similar asset having same rate of depreciation. That is what is called as block of asset. Okay? Similar asset and having same rate of depreciation. Now, what are the various types of asset which you may have? What are the various types of asset which you may have? Assets may be classified into four types. Asset may be classified into four types. One is building. Okay, one is building. Second is furniture. Third is plant and machinery. Fourth is intangible asset. These are the four classifications for block of asset. Building, furniture. You can classify your assets only into these four categories. Either I will call an asset as building or furniture. Items which are not building, which are not furniture, will be called as plant and machinery. And there is this intangible asset as well. Intangible asset. Okay, intangible asset. Now, let us see what are the depreciations, possible depreciations. Buildings, there can be of three types. Buildings, there can be of three types. There can be a residential building, office building, or building which is used for water supply project. Now, how can a business have a residential building? How can a business have residential building? That is normally in the form of quarters for employees or guest houses. These are only fall under residential buildings. So residential building, the rate of depreciation is only smaller, that is 5%. But a pure office building, such warehouse, go down, etc., will have a higher rate of depreciation of 10%. Okay, residential building, rate of depreciation is 5%. Office building and warehouse, the rate of depreciation is 10%. Then there is a building which is used for water supply purpose. The depreciation is 40%. So buildings can be 5% building, 10% building, or 40% building. All furniture rate of depreciation is 10%. There is no subclassification for furniture. All furniture depreciation is 10%. Then there is plant and machinery. Plant and machinery can be, some plant and machinery we can claim depreciation at 15%. Some plant and machinery, the rate of depreciation is 20, some it is 30, and some it is 40. So 15% is the general rate. 20% is for ocean-going ships, vessels, etc. 30% is for taxis. 40% is for aeroplane, computers, books owned by professionals, and lending libraries. So these are the various subclassifications of plant and machinery. And intangible asset, the rate of depreciation is always 25%. Intangible asset like patent, copyright, trademark, franchise, license, etc. The rate of depreciation is 25%. So these are the four classifications for asset. Okay, these are the four classifications for asset. One is building, second is furniture, third one is plant and machinery, and fourth one is intangible asset. Now, grouping, block of asset is actually grouping of asset into various categories. We can group only similar asset having same rate of depreciation. That is a definition which I had first mentioned you. Block of asset means it is similar asset having same rate. So what does it mean? A building with 10% depreciation cannot be grouped with furniture 10%, even though they have same rate of depreciation. A building having 10% depreciation cannot be grouped with furniture having 10%, even though they are having same rate, because building and furniture, they are not similar. Building and furniture, they are not similar. Okay, they are different types of asset. On the other hand, if you have two office buildings, one in Chennai and the other in Bangalore, Both Chennai and Bangalore buildings are grouped together to form one block. Okay. A residential building which is eligible for 5% depreciation cannot be grouped with 10% office building because they have different rate of depreciation. So it has to be similar and also should have same rate. Furniture cannot be grouped with plant and machinery cannot be grouped with building cannot be grouped with furniture. Only buildings can be grouped together, only various furniture can be grouped together, only various plant and machinery can be grouped together if they have same rate of depreciation. Okay, so that is how we charge depreciation. Depreciation is not charged on individual assets. Depreciation is charged only on block of asset. Depreciation is charged on a group. That group is called as block. Now, that is one term for calculating depreciation. Block of asset means similar asset having same rate of depreciation grouped to form one block. Okay. Then next term is, here we calculate depreciation on closing written down value of the block. Depreciation is calculated on closing written down value of the block. Now, what is closing written down value? Closing written down value is opening written down value. We start with the opening written down value. You add any assets which are newly purchased during this year to the same block. Any additions to the same block are to be added. If the additions are to be added, then we have to deduct the sale consideration. There is any assets which are sold or it has been destroyed, any amount which you receive upon sale or destruction, that will be deducted. Okay, start with opening written down value, add additions to the block and deduct it from the block if the asset is sold. See, one important point is when an asset is sold, what you deduct from the block is not the cost of the asset or written down value of the asset. That is not what is deducted from the block. What we deduct is the sale consideration. Sale consideration, the amount which is received on sale or destruction of the asset is deducted to arrive at the closing written down value. Okay. Opening written down value, add additions, less sales. That way we arrive at the closing written down value and we calculate depreciation on closing written down value. Do you understand? So that is the second term. First we have to group the assets. We have to arrive at the written down value and then calculate depreciation. So what do we add to the block? Okay, we have to add the cost of asset to the block. What do you mean by cost? That is another term. What do you mean by cost? Cost here means not just the purchase price of the asset. Something are to be added, one item is to be deducted. Okay, something is to be added, one item is to be deducted. Now, what will be added to cost and what will be deducted from the purchase price? First of all, start with the purchase price of the asset. Cost of the asset is 20 lakhs. Okay, but this 20 lakh, out of this 20 lakh, I receive a grant of 2 lakh, a subsidy of 2 lakh from the government to purchase this asset. Which means now my expenditure, it's not 20. My expenditure is only 18. So I can claim depreciation only on 18. Which means subsidy or grant received for purchase of some asset will be deducted from the price of the asset. Okay. Subsidy or grant received for purchase of the asset will be deducted from price of the asset. So 20 lakh worth machinery, I got 2 lakh subsidy. My cost price is, for the purpose of depreciation, my cost price is 18 lakh. That is first step. We have deducted subsidy or grant. So many other items are to be added to the cost of asset. So many items are to be added to cost of asset. What are further to be added to cost of the asset? Let's take an asset which I have purchased from Coimbatore. Okay, I have purchased an asset from Coimbatore. From Coimbatore all the way to Chennai. This asset is purchased from Coimbatore all the way to Chennai. I have to incur freight, loading. Reached in Chennai, I have to unload. So I'm paying expenditure for all these. Freight will be added. Loading or unloading will be added to the cost of the asset. Then Once the machine arrived in Chennai, I had to incur expenditure for installation of this asset. Okay, I had to make some special electrical wiring. A platform had to be constructed so that the plant and machinery could be kept on that. So some installation charges were incurred. That is also to be added to the cost of asset. Then, third point. I have taken this, I have purchased this asset by taking a loan. I have taken a loan, purchased this asset. Okay, I have taken a loan. Loan was taken in July. Loan was taken in July. And the asset was used only from September 1. Okay, the key was turned only on September 1. The machine was purchased in July, but the machine was used only from September. So July, August, I am paying interest on loan. I am paying interest on loan in July and August. Before the machine is put to use, I am paying interest on loan. That interest on loan shall also be added to cost of asset. Interest on loan paid during the month of July and August will be added to cost of asset. Before the machine is put to use, if we are incurring any expenditure on that machine, that will be added, that will be forming part of cost of asset. Okay, so these are three items which are to be added to cost of asset. Let us see. First, we identify the cost price. From the cost price, we deduct subsidy or grant. Okay, amount which is made by some other person. We have to add three items, that is freight, loading and unloading, installation charges, interest on loan till the asset is put to use. From September onwards, if you are paying any interest, that will be debited in P&L account, that is not capitalized. But interest paid on a loan for purchase of asset till the asset is put to use will be capitalized. So this is the definition of actual cost. Okay, so we have seen three terms for calculation of depreciation. One is block of asset. Second one is depreciation. We are following the written down value method here. And depreciation is calculated on closing written down value. Depreciation is calculated on closing written down value. And we have to arrive at the actual cost because actual cost is added to the block. Okay. One more thing. If you are purchasing an asset worth more than 10,000 and payment is made on a single day to a single person, otherwise than by account pay, check or draft, then that amount will not be added to cost of asset. In other words, there is no depreciation if the payment for purchase of asset is made in cash. Payment for purchase of asset is made in cash and the value of asset exceeds 10,000. Single day you are making payment otherwise than by account pay, check or draft or electronic clearing service, then that value of asset will not be added to cost of asset. So you lose depreciation there. You lose depreciation. So make sure that whenever you are purchasing an asset worth more than 10,000, payment is made by account pay, check, draft or ECS. Okay. So now let us calculate. Let us now find how do we calculate depreciation. How do we calculate depreciation? Let's take a block. Okay. There are two assets with me. There are two assets. Asset A, the opening written down value of which is 3 lakh. And there is another asset B. Again, the opening written down value of which is 5 lakh. Okay. There are two assets with you, A and B. And let us also assume that both are eligible for 15% depreciation, the general rate of plant and machinery, 15% of depreciation. So these assets were purchased long back, like asset A is with me from asset A is with me from 2021-22 and asset B is with me from 22-23. So these together constitute my opening written down value. Opening written down value. And you have to name a block by mentioning the percentage. So I will call this block as plant and machinery 15%. That is how I recognize an asset. This is how we should recognize an asset. There is no asset A, there is no asset B with me. Okay. What I call them is plant and machinery 15%. Plant and machinery 15%. So plant and machinery 15%, opening written down value is 8 lakh. Opening written down value is 8 lakh. During the year, I purchased one more asset, Plan C, having same rate of depreciation. Plan C was purchased on 1/6/2023. Plan C is purchased on 1/6/2023. Value of Plan C is 8 lakh. So that is added to the block. Now total value of the block is 10 lakh. Okay. I sold one asset from this block. I sold plant A from this block. I sold plant A from this block, and the sale consideration of plant A is, let us assume that this plant A is sold for 1,20,000. Okay. Plant A is sold for 1,20,000. So what we have to deduct here is sale consideration. What we have to deduct here is sale consideration of the asset sold. We are not looking into the cost of asset sold, or we are not looking into the written down value of the asset sold. So that way, plant A is sold for 1,20,000. What we are deducting is the money received. Money received. Plant A is sold on 1st January 2024. So now the closing written down value of the asset is, closing written down value of the block is 10 lakh minus 1,20,000, which is equal to 8,80,000. 8,80,000. And the depreciation is calculated on 8,80,000. Depreciation is 8,80,000 into 15%. 8,80,000 into 15% is the depreciation. Okay. So this is how we calculate depreciation. This is how we calculate depreciation regarding block of asset. What do you understand from here? There is no individual asset here. When we group them into block, we are not looking into the individual details. Like Plan C is purchased only on 1/6/23, is it not? Plan C is purchased only on 1/6/23. That is, asset is used only for a period of 10 months in this year. Even then, we calculate full depreciation. Similarly, Plant A is used for 9 months during this year. But we don't calculate depreciation on Plant A for this year. Plant A is fully deducted, and only on the balance we are calculating depreciation. So the details regarding individual assets is not relevant. I am concerned only with the closing written down value of the block. This is the amount. This is the amount upon which I calculate depreciation. Closing written down value of the block. Do you understand? Everything that is closing written down value means as on 31st March. As on 31st March 2024, the block should have a closing written down value. Then I will give you depreciation on that value, on closing written down value. I hope that is clear. Okay. So this is what we are looking into in depreciation. We don't look into the details of individual assets. We consider only the closing written down value. Closing written down value into rate will be the amount of depreciation. This is the general rule. For calculating depreciation. When there is a general rule, you have to know that there are some exceptions which I will be talking about. So this is the general. Okay, depreciation is calculated only on closing written down value. Depreciation is calculated only on closing written down value. Whatever happens in between the year, that is, you have purchased one asset of plan C on 1/6/23, you have sold one asset on plan A on 24. I will see what are the assets that are remaining on 31st March. 31st March, what is written down value? That is the value upon which I calculate depreciation. Date of purchase and date of sale is generally irrelevant. Date of purchase and date of sale is generally irrelevant because into that date and all. So generally, we need not look into the date of purchase of asset, so also of the date of sale of asset. Okay, this is a general rule. So the normal rule for calculating depreciation is closing written down value into rate of depreciation. Closing written down value into rate of depreciation. This is a general rule for calculating depreciation. Okay, so now let us come to the exceptions. If this is the normal rule, what are the exceptions to the normal rule for calculating depreciation? What are the exceptions? There are 5 exceptions. There are 5 exceptions. I'll start with this. No WDV, no depreciation. Let me start with this. Let me continue that. This is exception 1. Exception 1. 8 lakh, 2 lakh, 10 lakh. Plant A is sold for 12 lakh. See, in the earlier example, I had told that plant A was sold only for 1 lakh 20. 1 lakh 20. In this example, plant A is sold for 12 lakh. Okay. The written down value of A and B added together is 8 lakh. There is plant C for 2 lakh. Total now come to 10 lakh. And plant A is sold for 12 lakh. What happens now? Now the written down value is in negative. Closing written down value is negative. Negative means 0. There is no written down value at the end of the year. If there is no written down value at the end of the year, depreciation is 0. You cannot charge depreciation for this block. You cannot charge depreciation. If the closing written down value is 0, then there is no depreciation. Okay, that is exception 1. So opening written down value 8 lakh, add additions 2 lakh, total become to 10 lakh, sale value is 12 lakh, written down value has become negative. Negative means 0. We are charging depreciation only on written down value. Since there is no written down value, there is no depreciation. So there is a first exception. No written down value, then no depreciation. Okay. Now let us come to the second exception. This is the second exception. What is second exception say? Let me again give you an example. Opening written down value 8 lakh, additions 2 lakh. Now I get 10 lakh. In this case, what I did is I sold A plus B plus C. All assets are sold. Okay. All assets are sold in this case. Asset A is sold, asset B is sold, and also asset C is sold. All 3 assets are sold. A plus B plus C is sold. And the sale value is, let us assume 4,50,000. A, B, and C is sold for 4,50,000. There is a closing written down value of 5,50,000. There is a closing written down value of 5,50,000, but there is no asset there. As on 31st March, when I went to my factory, as on 31st March, in order to charge depreciation, I went into my factory building, but there was no asset there. How can I give depreciation then? How can I give depreciation? I can give depreciation only to an asset. There is no asset. As on 31st March, there is no asset there. So there is no depreciation in this case. Okay. What do you mean by this? What do you mean by this? In order to charge depreciation, 2 conditions are important. In order to charge depreciation, 2 conditions are important. See, between these 2 words between these two conditions, I have used the term and, which means only these two conditions are satisfied. Both the conditions are satisfied. We can charge depreciation. We can charge depreciation only if both these conditions are satisfied. Both these conditions. What is the first condition? Block should have a positive written down value on 31st March. Block should have a positive written down value as on 31st March. See, 8,80,000, there is a positive written down value. That is not in negative. And the second condition is that block is not empty on 31st March. Minimum one asset should be there in the block on 31st March. If these two conditions are satisfied, we will be calculating depreciation in respect of that block. Okay? If these two conditions are satisfied, we will be calculating depreciation in respect of that block. What are the two conditions? The block should have a positive written down value on 31st March and the block is not empty on 31st March. The block is not empty on 31st March. Block should have a positive written down value on 31st March. See, here there is a positive written down value. 8,80,000 is a positive written down value. And there are two assets B and C here. Is it not? In the general rule? In the general rule, 8,80,000 represents the value of two assets B and C. This is the value of two assets B and C. So we can calculate depreciation on 8,80,000. What happens in this case? In this case, written down value is 0. Written down value is 0. Even though there are assets there is no written down value. Okay, so there is no depreciation. In order to charge depreciation, two conditions. Positive written down value as on 31st March and there should be minimum one asset on 31st March. Minimum one asset in that block. In this case, there is no written down value. In exception 1, there is no written down value even though there are assets. In this case, there is no asset. Block is empty. As on 31st March, there is no asset there. Even though they are having a value of 5,50,000. I'll come to that. What does that 5,50,000 represent? Okay. What does that 5,50,000 represent? I'll come to that. So these are the two exceptions which we have discussed. First of all, I told that block will be eligible for depreciation only if two conditions are satisfied. One is there should be a positive written down value as on 31st March and there should be minimum one asset on 31st March. That is, block is not empty on 31st March. Okay. Now, if depreciation is not charged in respect of a block, if depreciation is not charged in respect of a block, then what will arise? Capital gain or capital loss will arise. Okay, if depreciation is not charged in respect of a block, there will be either capital gain or capital loss. Either capital gain or capital loss. Let us see how that will come. Capital gain or loss. So no depreciation is charged in case of exception 1. No depreciation is charged in respect of exception 1. So if depreciation is not charged, then there will be another thing happening for the block. That is what is called as capital gain. That is what is called as capital gain or capital loss. Let us come to situation 1, exception 1. Exception 1. The value of the block was 10 lakh. Okay, the value of the block is 10 lakh. And one asset is sold for 12 lakh there. So it is as if the block on sale of the asset in the block, there is a profit. Block worth 10 lakh is sold for 12 lakh. Is it not? Block worth 10 lakh is sold for 12 lakh. So this minus 2 lakh is a profit. That is what is called as capital gain. Minus 2 lakh is a profit. The negative written down value represents the profit which you have made and then we call it as capital gain. In exception 2, the block value is 10 lakh. The block value is 10 lakh and the asset worth 10 lakh is sold for 4 lakh 50. All assets worth 10 lakh are sold for 4 lakh 50. So this represents capital loss. This represents capital loss. 5,50,000 represents capital loss. Okay. So these are the three cases. The general case where there is block written down value as at the end of the year, and also there are assets in the block at the end of the year. So we are calculating depreciation. In exception one, there is no asset, there is no written down value, but there is asset. But since there is no written down value, there is no depreciation, we calculate capital gain. Third case, all assets are sold. There is no asset, there is no depreciation, but this assets are sold for a lower value, then there will be capital loss. So depreciation and capital gain will not come together for a block. Either a block has depreciation or a block has capital gain. Okay, either a block has depreciation or the block has capital gain. Both will not come together. Depreciation and capital gain do not arise together for a block. First of all, see whether we can charge depreciation. If depreciation cannot be charged, then capital gain or capital loss will come. Okay, first of all, see whether there is depreciation. If depreciation cannot be charged, there will be capital gain or capital loss. Okay, so that was exception 2. And also, do not ask me whether a single asset has made profit. We are not concerned with individual assets here. Like if you look into the first case, asset A had a written down value of 3 lakh, and that asset A was sold during the year for 1,20,000. That asset A was sold in the year for 1,20,000, is it not? The value of the asset as on 1st April was 3 lakh, and that is sold for 1,20,000. Meaning, if you look into asset A individually, there is a loss. But the loss of asset A gets adjusted in the written down value of the block. And that loss is not separately charged. That loss is not separately charged as capital gain or capital loss, but instead the loss of sale of asset A gets adjusted, gets blended in the written down value. It gets mixed in the written down value of the block. Okay, while calculating depreciation. I'll also explain why this method has been introduced, why we are using this block of asset method rather than calculating individual assets depreciation. I'll explain that once I complete this. So that is exception 1, that is exception 2. Then exception 3. Exception 3 says that no depreciation on cars which are imported between 1975 and 2001. No depreciation for car imported between 1975 and 2001. If you are rich enough, if you can afford to import a car, then why do you need depreciation? If you are rich enough to import a car, then there is no depreciation. That is exception 3. Okay, exception 3. Exception 4 says that in case of amalgamation or demerger, depreciation is calculated proportionately. In case of amalgamation or demerger, depreciation is calculated proportionately. This is the only case where we look into the actual number of days usage. This is the only case where we look into the exact number of days usage. Okay, in case of amalgamation and demerger. Say SBT amalgamated with SBI. State Bank of Travancore got amalgamated with State Bank of India. State Bank of Travancore has used an asset for 3 months, and for the remaining 9 months, the asset was used by State Bank of India. Amalgamation happened on 1st July. So April, May, June, the asset was used by SBT, and from July onwards, the asset is used by SBI. Okay, from July onwards. In this situation, for 3 months, 3 by 12, depreciation will be given to SBT, and 9 by 12, the depreciation will be given to SBI. This is the only case where there is a change in ownership of asset on account of amalgamation or demerger. We calculate depreciation proportionately on the basis of exact number of days usage. Now the last exception, exception 5. Half rate depreciation if the asset is used for less than 180 days. Half rate depreciation if the asset is used for less than 180 days. Let me explain that again with an example. Let me copy this down. Again, we have two assets, asset A and asset B, total written down value of which is 8 lakh. Okay. Here, I'm changing the date of purchase of A. Date of purchase of C. Date of purchase of C. Plan C is purchased on 1st December 23 for 2 lakh. Plan C is purchased. Plan C is purchased on 1st December 23 for 2 lakh. So now our total came to 10 lakh. Let me continue the same example. Plant A is sold for 1,20,000. Plant A is sold for 1,20,000. So now the closing written down value is 8,80,000. Okay, 8,80,000. Now let us analyze this part. See, earlier I had used the date of addition was 1st June, and now I have changed it to 1st December. Do you understand? Here it was 1st June. I have changed this to 1st December. Okay. Now let us see. What does this say? Total closing written down value of B and C together. B and C together is 8,80,000. A is already sold. So now we have two assets, B and C. Its total value is 8,80,000. This block contains one asset which is used for less than 180 days. See, less than 180 days. 180 days means almost less than half a year. An asset is not used for half a year. It's not used for half a year, is it not? In that case, the Act says that depreciation for that asset can be claimed only at half rate. If an asset is not used for half year, depreciation is also eligible at half rate. You can claim depreciation only at half rate. Let us take this. 8,80,000 asset is purchased only on 1st December. 1st December means 4 months. 4 months, December, January, February, March. 4 months will at least around, it might come to 30 into 4, 30 days into 4, that is 120 days. So asset is used for less than 180 days. 8,80,000 contains one asset which is used for less than 180 days. 8,80,000 contains one asset which is used for less than 180 days. What is the value of that one asset? 2 lakh, is it not? 8,80,000 contains 2 lakh, which is used only for less than 180 days. On that 2 lakh, depreciation is calculated at 7.5%. On that 2 lakh, we can claim depreciation only at 7.5%. We are splitting this 8,80,000 into 2. Okay, we are splitting this 8,80,000 into 2. Let us split that. We are splitting the closing written down value. Okay, need not look into the opening written down value and any other amount. Always compare closing written down value. Always compare closing written down value. So there is one asset called worth 2 lakh, which is used for less than 180 days. So how much is balance? How much is balance? Balance is 6.8 lakh. Okay, 6.8 lakh. This 2 lakh is used only for less than 180 days. So our depreciation will be at half rate. 2 lakh into 7.5% plus 6.8 lakh into 15%. This will be our depreciation. 2 lakh into 7.5%. And as it is used for less than 180 days means depreciation is only given at half rate. If the asset is not used for half a year, depreciation is also for half rate. So 2 lakh into 7.5% plus 6.8 lakh. 8,80,000 minus 2 lakh, that will come to 6.8 lakh, that into 15%. This will be total depreciation in this case. We are talking about exception 5. Exception 5. Exception 5 says If the asset is used for less than 180, depreciation is also charged at half rate. Okay. And exception 5, there are two more cases. See, always when you apportion this closing written down value, apportion towards the value of new asset first. Apportion towards value of new asset. Okay, which means only amount in excess of 2 lakh. In this example, the value of new asset is 2 lakh. Only the closing written down value in excess of 2 lakh is considered to be old asset. Only closing written down value in excess of 2 lakh, that is cost of asset, cost of new asset, in excess of 2 lakh will be treated as old asset. Let me explain that. Another example, 8 lakh, 2 lakh, 10 lakh. Plant A is sold for 9 lakh. Plant A is sold for 9 lakh. Closing written down value is 1. As I told you earlier, apportion closing written down value towards the value of new asset. Towards the value of new asset. That is, only that written down value in excess of cost of new asset is old asset. Written down value in excess of cost of new asset is old asset. In excess of 2 lakh is old asset. There is no amount in excess of 2 lakh. So 1 lakh fully represents the new asset purchased. So depreciation on 1 lakh will be at 7.5%. There is no amount in excess of 2 lakh in written down value. Written down value up to 2 lakh is new asset. Written down value up to 2 lakh. 2 lakh meaning the cost of the asset which is used for less than 180 days. The new asset which is used for less than 180 days. So 1 lakh into 7.5% is the rate of depreciation. Okay, 1 lakh into 7.5%. That is another case in this exception. 1 lakh into 7.5. Let's again continue. This is again exception 5, another case. Exception 5, another case. Okay. Exception 5 means less than 180, half rate. Now this exception is Plan C was purchased. Plan C was purchased on 1st December. Instead of Plan A, we are selling Plan C on 1st January. We are selling Plan C on 1st January for any value. Let us take 3 lakh. So now the closing written down value is 7 lakh. Plan C is purchased in December. It is sold in January. Let me ask you. The closing written down value of 7 lakh. Which all assets are represented by 7 lakh? Which all assets are represented by this 7 lakh? 7 lakh represents asset A and B, is it not? 7 lakh represents asset A and B. 7 lakh represents asset A and B. There is no Plan C in closing written down value. And A and B are used for more than 180 days. A and B are used for more than 180 days. So here depreciation is 7 lakh into 15%. 7 lakh into 15%, old rate. Okay. 7 lakh into 15%. Here the written down value, closing written down value does not contain any asset which is used for less than 180 days. Because asset has been purchased in the year, asset has been sold during the year. Only if closing written down value contains an asset which is used for less than 180, depreciation can be charged at half rate. Only if closing written down value contains an asset which is used for less than 180 days, depreciation need to be charged at half rate. Okay, closing written down value should contain an asset which is used for less than 180 days. Only then depreciation will be charged at half. So these are the 5 exceptions. So let us discuss further. General rule is closing WDV into rate of depreciation. But the exceptions are no WDV, then no depreciation. See, no WDV. WDV is negative. Second case is block is empty, no depreciation. We have sold all assets. A, B, and C sold on 1st January. As on 31st March, there is no asset in the block, so no depreciation. If you are rich enough to import a car, then there is no depreciation, but this restriction was there only from 1975 to 2001. Now that has been relaxed. Even if you are rich enough to import a car, you can claim depreciation. We can claim proportionate depreciation in case of amalgamation and demerger. Proportionate depreciation, that is only case where we look into the exact number of days. And last case, where the closing written down value contains any asset which is used for less than 180 days. Closing written down value contains any asset which is used for less than 180 days, then on that asset, we can claim on the depreciation at half rate. So here, 8,80,000 contained 2 lakh, which was used for less than 180 days, 2 lakh into half rate, 6.8 lakh into 15%. In this case, there is only a written down value of 1 lakh. Anything up to 2 lakh is new asset. Only written down value in excess of 2 lakh will be old asset. So entire 1 lakh is charged at 7.5. But in the last example which I gave you, there is no asset, that is plan C has been purchased during the year and is also sold during the year. So as on 31st March, we don't have any asset with us which is used for less than 180 days. So 7 lakh will be eligible for full rate of depreciation. Okay. This was the normal depreciation which we had been talking about. So far, we had discussed about normal depreciation. Okay, normal depreciation. Now, for certain assets, we can claim an extra depreciation. That extra depreciation is called as additional depreciation. Okay, for certain assets, we can claim an extra depreciation. Extra depreciation is called as additional depreciation. Additional depreciation is not available for all. It is not available for all. It is available only for manufacturers. Manufacturers. Okay. Those who are having a factory. So traders, those who are in service, professionals, they cannot claim additional depreciation. Second point, additional depreciation is only for plant and machinery. We cannot claim additional depreciation for building and furniture. And what is rate of additional depreciation? Additional depreciation has no relation to the written down value. Additional depreciation is calculated on cost. Okay, additional depreciation is calculated on cost, and the rate of additional depreciation is 20%. Rate of additional depreciation is 20%. Additional depreciation is calculated on actual cost, and if the asset is used for less than 180 days during this year, if the asset is used for less than 180 days, then the rate of additional depreciation is 10%, and the balance 10% will be claimed in the next year. Okay. So these are the rules for calculating of additional depreciation. Point number 1, additional depreciation is available only for manufacturers. Point number 2, additional depreciation is available only for plant and machinery. Then rate of additional depreciation is 20% on actual cost, but if it is used for less than 180 days, 10% in this year and balance 10% in the next year. See, this additional depreciation is claimed only for additions, assets which are purchased during this year. Okay, additional depreciation can be claimed for an asset only in the year of purchase. Only in the year of purchase. This is not a continuous affair. Normal depreciation, we know it's a continuous affair. Year by year, we keep on claiming normal depreciation. As long as there is written down value, we can continue claiming normal depreciation. As long as there is written down value, we can continue claiming normal depreciation. But additional depreciation is not like that. Additional depreciation is available only in the year of purchase of asset, and additional depreciation is claimed only for plant and machinery. Only for plant and machinery. But there are certain plant and machinery which are not eligible for additional depreciation. Which are those plant and machinery which are not eligible for additional depreciation? 1, ships. 2, aeroplanes. 3, vehicles. So any type of vehicle, whether it runs on road or in air or in water, is it not? There is no additional depreciation. Any type of vehicle, there is no additional depreciation. Ships, aeroplanes, and road transport vehicles are not eligible for additional depreciation. Second, the fourth item, second-hand plant and machinery is not eligible for additional depreciation. Second-hand. That is only a brand new asset is eligible for additional depreciation. Brand new. Fourth, office appliances are not eligible for additional depreciation. Then what for we claim additional depreciation? Additional depreciation is claimed for plant and machinery which is installed in factory. See, additional depreciation is for manufacturers. Additional depreciation is for manufacturers. So additional depreciation can be claimed only for plant and machinery which are installed in factory. Okay. Then assets for which 100% deduction is already claimed in section 35 and 35 AD. We are discussing that. You have already claimed 100% deduction, not by way of depreciation, but under some other term. We are claiming 100% deduction. Already you have claimed 100% deduction for that asset, for that plant and machinery. Again, you cannot claim additional depreciation. For that asset, there is no additional depreciation. So generally, these are the rules regarding additional depreciation. Let us recollect. Additional depreciation is available only for manufacturers. That is the first point. Additional depreciation is available only for manufacturers. Traders and professionals cannot claim additional depreciation. Second case, additional depreciation is claimed only on plant and machinery. Only on plant and machinery. There is no additional depreciation on building. There is no additional depreciation on furniture. Even certain type of plant and machinery are not eligible for additional depreciation. What are they? The vehicles like ships, aeroplanes, road transport vehicles. There is no additional depreciation on second-hand plant and machinery. There is no additional depreciation on office appliances. There is no additional depreciation on assets which are eligible for 100% deduction under some other section. Okay. Then power sector units. Power sector units. Power sector units are eligible for additional depreciation. We'll see there is a special rule for power sector units. They are eligible for additional depreciation only if written down value method. Power sector units are eligible for additional depreciation only if they are following written down value method. Okay, we'll see that because power sector units have an exception. They can claim depreciation on straight line method if they want. Okay, so power sector units are eligible for additional depreciation only if they are following written down value method. And point number 2, printing and publishing. See this printing press. Printing press, they have huge amount of machinery installed in their press. They are incurring some certain printing machinery. They cost around 2 crore and 3 crore. So it had always been their concern as to whether they can claim additional depreciation on the machinery installed in their press. There is a circular by the Income Tax Department which says that printing and publishing also amounts to manufacture. So the press persons, printing press persons, they can claim additional depreciation on the machinery which is installed in their printing press. Okay, so that was regarding additional depreciation. Another term is called as unabsorbed depreciation. Unabsorbed depreciation. What do you mean by unabsorbed depreciation? Profit before depreciation is 3 lakh. Okay. Depreciation for the year is 5 lakh. All right. Depreciation for the year is 5 lakh. So now my profit comes to 2 lakh. Okay. Even though it's at a loss, I have to charge depreciation. Depreciation is compulsory. Depreciation is compulsory. So now my profit is minus 2 lakhs. Minus 2 lakh is my profit now. All right. This minus 2 lakh loss has arisen on account of depreciation. This minus 2 lakh loss has arisen on account of depreciation. Loss on account of depreciation is called as unabsorbed depreciation. On account of depreciation is called as unabsorbed depreciation. Okay, 2 lakh loss has arisen on account of depreciation. If depreciation had not been written, this company would have been, this organization would have been at a profit, but depreciation is compulsory. When you wrote depreciation, there was a loss, and that loss which arose now on account of depreciation is called as unabsorbed depreciation. Okay. Loss on account of depreciation is called as unabsorbed depreciation. Now, what happens if unabsorbed depreciation arises? What happens if unabsorbed depreciation arises? In other words, you may use another term, depreciation which could not be absorbed by profits. Depreciation which could not be absorbed by my profits because of insufficient profits. There were no sufficient profits here. So my depreciation could not be fully adjusted against profit. That is also called as unabsorbed depreciation. So here 2 lakh is called as unabsorbed depreciation. Okay. Now what happens if I have that loss? Can this loss be adjusted against anything else? Can this loss be adjusted against any other profits? Yes, definitely. You can adjust this loss against any other profit. Let us take, I have an income from house property. Income from house property of 4 lakh 20. Income from house property of 4 lakh 20. This minus 2 lakh can be deducted from house property profit, house property income. So that way, my total income would be only 2 lakh 20. Total income is 2 lakh 20. Okay. Minus 2 lakh is adjusted 4 lakh 20, and thus my total income now comes to 2 lakh 20,000. So this is what you should do. You can adjust this unabsorbed depreciation against any other income for the same year. However, there is a restriction. There is a restriction. Unabsorbed depreciation can be deducted from any other income of the same year except salary. You cannot adjust unabsorbed depreciation against salary. You cannot adjust unabsorbed depreciation against salary, but instead it can be adjusted against any other head of income like house property or capital gain or other sources. Okay, it cannot be adjusted against any other, it can be adjusted against any other income, but no adjustment is possible with salary. Now, again, let me take another example. I have income from house property of only 1 lakh, or let us make another 80,000, which means balance I have, again, there is a loss left. Remaining loss, remaining unabsorbed depreciation is 1 lakh 20. My initial unabsorbed depreciation was 2 lakh, but my house property income was only 80,000 for the year. So still I have, still I have unabsorbed depreciation, which is equal to minus 1 lakh 20,000. What can be done with this minus 1 lakh 20,000? Minus 1 lakh 20 can be carried forward. If it cannot be adjusted during this year, it can be carried forward to the next year. Next year we will adjust against next year's income. Any income except salary again. Except salary. Current year, I told you cannot set off against salary. So next year also we cannot adjust that against salary, but you can adjust that against any other income of the next year other than salary. That way, for how many years you can carry it forward? For how many years you can carry it forward? You can carry forward this for any number of years. For any number, there is no time limit to carry forward of unabsorbed depreciation. There is no time limit to carry forward of unabsorbed depreciation. Okay. So that was the rule regarding carry forward of unabsorbed depreciation. Depreciation will be first deducted from business profit. Any unabsorbed depreciation to be deducted from any other income from the same year except salary. There is still unabsorbed depreciation. It can be carried forward to the next year to be set off against any income of the subsequent year except salary. Depreciation can be carried forward without any time limit. Without any time limit. Now, the last point in depreciation is, as I told you, that was quite a big area of depreciation. The last point, now we are coming to terminal depreciation. Terminal depreciation, that is another term. So we have discussed about normal depreciation. We have discussed about additional depreciation. We have discussed about unabsorbed depreciation. Now there is another term which is called as terminal depreciation. Terminal depreciation. Let me first explain to whom this is applicable. It's applicable to power sector units. Power sector units means those organizations which are engaged in generation or distribution of electricity. Generation, distribution, transmission of electricity, they are called as power sector units. Power sector units are given an option. Power sector units are given an option. They can calculate depreciation either on straight line method or on written down value method. Okay. This is the only person who can claim depreciation on straight line. You and me have no option. You and me have no option. We have to claim depreciation under written down value method. But power sector units are given an option. Power sector units, they may claim depreciation. They may claim depreciation under straight line method if they want. If they want, that is up to them. So they may choose depreciation on straight line, but again, once an option is chosen, they have to consistently follow that. They cannot change their decision once taken. So they are claiming depreciation on straight line method. If depreciation is calculated on straight line method, we have to calculate depreciation on cost, is it not? So there we calculate depreciation on individual assets. If we add several assets together, we won't get an idea about individual cost of asset. So if we are following straight line method, there is no block of asset rule applicable. There is no block of asset, there is no grouping. Straight line method of depreciation, we calculate on individual assets. Okay, individual assets is the asset on which we calculate depreciation. So let us take an example. Cost of asset purchased is 10 lakh. Cost of asset purchased is 10 lakh. Okay. And for the sake of calculation, I am assuming a 10% depreciation. We are following straight line method, right? We are following straight line method. So the rate of depreciation is 10%. So depreciation for 1 year will be 1 lakh. Is it not? Depreciation for 1 year will be 1 lakh. This asset is used for 3 years. So what is total depreciation for last 3 years? What is total depreciation which I have claimed for last 3 years? 1 lakh into 3, 3 lakh. 1 lakh into 3. So I have been using this asset for last 3 years, and that way now my opening written down value on 1/4/23. We are talking about the current year. On 1/4/23, the opening written down value is 7 lakh. Okay. Cost is 10 lakh. I have claimed depreciation for the last 3 years. Last 3 years depreciation 3 lakh I have already claimed. And now the opening written down value as on 1st April 23 for this asset is 7 lakh. I'm selling this asset for 5 lakh. which means there is a loss of 2 lakh. Is it not? There is a loss of 2 lakh. Normally, when you sell an asset and there is a loss, that loss or profit, whatever, there is a sale of asset and there is a loss of profit, profit or loss will be charged under the head capital gain. That is a general rule. Is it not? But an asset on which straight line method of depreciation is charged is sold and there is a loss. That loss is called by a special name. That loss is what is called as terminal depreciation. Loss on sale of asset on which straight line method of depreciation is charged. There is a loss on sale of asset on which straight line method of depreciation is charged. That loss is called by a special term, and that special term is called as terminal depreciation. And this loss is not charged as capital loss. It is treated as a loss under the head business. This is a business loss. This is charged under the head PGPP. It's not charged under the head capital gain. See, the point is, every loss has got separate rule for set off and carry forward. So this loss of 2 lakh will set off and carry forward as if it is a loss under the head PGPP and not a capital loss. So this is the rule where the loss happens on an asset on which depreciation is charged on straight line method. Loss on sale of such asset is called as terminal depreciation and is treated as a loss under the head business and not capital gains. So we have to see what happens if there is a profit. What happens if there is a profit? Let us continue with the same example. 10 lakh. Total depreciation charge for the last 3 years is 3 lakh. That way we have a value of 7 lakh. Okay. Now I'm selling this asset for, how much shall the asset be sold for? If you have to get a profit, this asset is sold for 11.5 lakh. Okay, this asset is sold for 11.5 lakh. Here there is a profit. Here there is a profit. Profit is 4.5 lakh. Profit is 4.5 lakh in this case. Okay, profit is 4.5 lakh. If there is a profit, what we have to do? This profit has to be split into 2 parts. Okay, this profit has to be split into 2 parts. So let me divide this profit into 2 portions. Let me split this profit into 2 portions. One portion is amount equal to depreciation. Profit equal to the depreciation allowed earlier. Amount equal to depreciation. Depreciation already claimed. How much is already claimed? 3 lakh. 3 lakh. And the excess, extra profit. How much is the extra profit? Extra profit is 1.5 lakh. Okay, so we are dividing the profit into 2 portions. Profit up to depreciation allowed. This 3 lakh deduction was earlier allowed under the head business. So when you get the profit back up to 3 lakh, this will be charged under the head business and this is given a new term. This profit is given a new name that is called balancing charge and this is treated as a profit under the head PGPP. This is treated as a profit under the head PGPP. 1.5 lakh will be charged under capital gain. So this is what we do when there is profit. Loss fully called as terminal depreciation and it is a loss under the head. It is a loss under the head business. Profit, divide the profit into 2 portions. Profit up to depreciation already given. Profit up to depreciation already claimed. Already claimed depreciation is 3 lakh. So profit up to 3 lakh is called by a special name that is called as balancing charge. It is a profit to be charged under the head PGBP. Extra profit of 1.5 lakh will charge under the head capital gain. So let us read what is given there. Profit has to be divided into 2 parts. Amount equal to depreciation already allowed is called as balancing charge and it is taxed as business income and excess profit is charged under capital gains. Okay. So we have completed everything regarding depreciation, normal depreciation, additional depreciation, unabsorbed depreciation, terminal depreciation. Along with terminal depreciation, we also claimed another profit balancing charge. Okay. So far we have discussed three deductions that are possible. Three deductions. One is under section 30 relating to building, section 31 relating to machinery, section 32 relating to depreciation. Now we come to the fourth deduction. Items which can be debited in P&L account. That is what we are discussing right now. Items which are debited in P&L account. Okay. The fourth item which can be debited in P&L account is scientific research expenditure, and that is given by section 35. Scientific research expenditure, which is given under section 35. Scientific research expenditure. Normally, when a person carries on business, in certain cases that might be necessary that he has to conduct a lot of research about his products. So sometimes research becomes part of the business activity. When a person carries out research, we can claim deduction for whatever expenditure he has incurred on scientific research. That is given under section 35. Okay, section 35. There are two possibilities. Either the businessman, he carries research by himself. He has an R&D department, research and development department in his organization. And there he has employed scientists and he is incurring expenditure on salary to scientists. He is paying rent on that building. So many other expenditure. He has purchased and plant and machinery for the purpose of carrying research. And that way he is incurring a lot of money. Or else, that is first option, incurred by himself. Or he can give donation. He can give donation to a laboratory that is carrying out scientific research. He can give donation to a third person who is engaged in scientific research. So these are the two options which are possible if you are doing scientific research. Either do the research by yourself, or or make donation to a third person. Make donation to a third person who is engaged in scientific research. And I'm giving him donation. Generally, donation is not a business expenditure, but donation for a scientific research can be treated as a business expenditure. So let us see. First, let us see own expenditure. Own expenditure. So I am doing textile business. I'm doing research on wash-free clothes, like clothes which do not require washing. I'm doing research on such textiles, a new textile which can be which are to be developed that doesn't require washing. It's just fresh the moment you show it in the sunlight. Okay, that will become fresh. So I'm doing some business relating to my business. So when you're doing research by himself, when a person is doing research by himself, you are doing research by yourself. The research expenditure will be allowed as deduction only if it is related to your business. The research shall be related to your business. Textile, I have to do research about textile itself. Okay. If I'm doing textile business and I'm doing research on atom bomb, I cannot claim deduction for atom bomb research. So I'm incurring expenditure and that expenditure is incurred in the current year. When it is my expenditure, I can segregate that expenditure as either capital or revenue. Okay. Capital expenditure, I can claim 100% deduction on all capital expenditure incurred for scientific research. I purchased a machinery, I purchased a building, I can claim 100% deduction, but there is no deduction for expenditure incurred on land. There is no deduction for expenditure incurred on land. Other than land, any other capital expenditure you incur, you can claim 100% deduction. Revenue expenditure again, current year revenue expenditure is fully allowed as deduction. Okay, revenue expenditure also you can claim 100% deduction. So own expenditure, current year, you can claim 100% deduction for both capital and revenue except land. Okay. Pre-commencement expenditure. Pre-commencement expenditure means expenditure which is incurred 3 years prior to commencement of business. Expenditure which is incurred 3 years prior to commencement of business. Many times what happens is we carry out research, the research becomes successful, we develop a new product, we develop a new product, and then we do commercial operation. Okay. I have been doing research for the last 3 years, the last so many years, for the last 5 years, I have been doing research. I developed a new formula. On the basis of new formula, tomorrow I started my business. So in this case, scientific research expenditure is incurred prior to commencement of business. Scientific research expenditure is incurred prior to commencement of business. Okay. Only expenditure which is incurred 3 years prior to commencement of business is allowed as deduction. Only expenditure which is incurred 3 years prior to commencement of business is allowed as deduction. For example, I have been doing research for the last 5 years. I'm commencing my operations today as on 20th April. Let's take 20th April 2024 is the date on which I'm commencing my business. I have been doing research for the last 5 years and I have developed a new formula. On the basis of new formula, I decided to start my commercial operations. So from today onwards, I'm doing my business. Scientific research expenditure incurred on or after 20th April 21. On or after 20th April 21 will be allowed as deduction during this year. That is, any expenditure incurred prior to commencement of business will be allowed as deduction the year in which business is commenced. But pre-commencement means only expenditure which is incurred 3 years prior to commencement of business. So business is commenced on April 24. Only expenditure which is incurred after April 21 will qualify as pre-commencement. Okay. Now, pre-commencement expenditure can also be divided into 2 types. It can be capital or revenue. Capital expenditure, again, 100% deduction except expenditure on land. Revenue expenditure, 100% deduction is available only to 2 items. That is, those items which cannot be avoided for research, salary and raw material. These are the 2 things which cannot be, without which research cannot be carried out. So we can claim deduction for salary and raw material which are given to research personnel. Okay, salary given to research personnel and raw material given to research personnel. Revenue expenditure, you can claim deduction only for these 2 items. But that too, if you want to claim deduction, we have to get approval from the government. Only then you can claim deduction for salary and raw material. Also, there is no deduction for perquisite which is given to research personnel. There is no deduction for perquisite given to research personnel. Okay, you can claim deduction for salary, but not for perquisites. So these are regarding scientific research. Let me repeat. First of all, we are talking about current year expenditure of the business person, own expenditure. Own expenditure, if you want to claim deduction, that should be related to your business. Otherwise, there is no deduction for own expenditure. Own expenditure can be divided into 2. It can be either current year expenditure or pre-commencement expenditure. Current year expenditure can again be divided into 2, that is capital or revenue. Capital expenditure, 100% deduction except land. Revenue expenditure, 100% deduction. Pre-commencement expenditure can also be allowed as deduction in the year in which business is commenced. But pre-commencement expenditure means only expenditure which is incurred 3 years prior to the commencement of business. Any expenditure incurred even before 3 years is not allowed as deduction anywhere. Pre-commencement expenditure can also be divided into 2 types. It can be either capital or revenue. Capital expenditure is 100% deduction except land. Revenue expenditure, there is 100% deduction only for salary and raw material. But for that, again, you have to get approval from the government, but there is no deduction for purposes. Okay. Now, if you are making contribution to a third person, that contribution which you have made to a third person will be allowed as deduction, even if it is not related to business. But this contribution you are making to a third person, it shall be an approved research organization. Research organization which is approved by the government. If you make any contribution to those approved research organizations, there will be 100% deduction. And there is no condition required that it shall be related to your business. Okay. Next is 35 AD. 35 AD. 35 AD deduction, that is the 5th deduction, that is not available to all businesses. It is allowable to only for 13 different types of businesses that are mentioned there. 13 different types of businesses. Only these 13 groups of persons who are engaged in these types of activities can claim deduction for the under 35 AD. And what is deduction that are available to them? There is 100% deduction for capital expenditure. Any capital expenditure you incur now itself, 100%. You purchase a plant and machinery, I give you 100% deduction now itself. You purchase a furniture, I'll give you 100% deduction now itself. Okay, but not available to furniture. It's again available only for plant and machinery. Anyway, the 13 different types of businesses that I mentioned here are cold chain facility, warehousing of agricultural produce, natural gas distribution network across the country between two countries, 2-star and above hotels, hospitals with 100 beds, housing project under affordable housing scheme, inland container depot and freight station, fertilizer pipeline for transportation of iron ore, semiconductor infrastructure facility. Okay, so these are the 13 different types of businesses that can claim deduction under this section. Deduction is 100% of capital expenditure. Now, what are the conditions? One, the deduction is available only for a new business. Okay, yours shall be a new business. Not only that, the business shall be new, it shall be new plant and machinery. However, 20% may be old and imported second-hand machinery is also treated as new. Okay, so minimum 80% shall be new plant and machinery. Audit is compulsory in order to claim deduction. But there is no deduction for land, goodwill, and financial instruments. Land, goodwill are those assets which we always expect to appreciate in value, and financial instruments means the investments which you have made in other companies. That is also not eligible for deduction. Pre-commencement expenditure is also allowed as well. Once you claim deduction under 3580, you cannot claim deduction under 10A and Chapter 6A. We'll be discussing all that later. So double deduction is not permissible. Double deduction. That is, if you choose 3580, you cannot claim deduction under Chapter 6A or 10A. Point number 7, the asset for which you have claimed deduction has to be used in the same business for a period of 8 years. This has to be used in that 13 different business. You cannot use it for some other business activity within a period of 8 years. But there is no problem if you sell the asset. Selling is permitted. Only thing is, you cannot use it for a non-3580 business. Once you have purchased an asset, you have claimed 100% deduction. You cannot keep this asset for your non-3580 activity. Okay, this asset shall be used for the same business activity for a period of 8 years. Now, what happens if you use it for some other business activity within a period of 8 years? Deduction allowed earlier will be treated as income. Deduction allowed earlier. Say, I purchased a asset for 5 lakh. I use it for 3580. I claim deduction for 5 lakh. In the next year, I'm using it for some other purpose. Then the 5 lakh deduction which was claimed in the last year will be now treated as income. However, when you claim that 5 lakh deduction, you had foregone depreciation. You had waived depreciation. When you claim deduction under 3580, there is no depreciation. So when 3580 deduction is cancelled, you can claim depreciation. Meaning, the amount to be treated as income is 5 lakh minus depreciation on 5 lakh. Depreciation for so many years of usage. If you have used asset for 1 year, 1 year depreciation can be deducted. If you have used asset for 2 years, 2 years depreciation can be deducted. And only the balance will be treated as income. Okay, so let me repeat that point once again. When an asset is used for 3580 and you have claimed deduction on that asset cannot be used for any other business activity for a period of 8 years. If you use that asset for a business activity within a period of 8 years, the consequence is that the amount of deduction allowed earlier will be treated as income in the year in which it was used for some other purpose. Say 5 lakh, I have purchased a plant and machinery last year. I claim deduction under 3580. This year, I use this asset for some other business activity. 5 lakh will be treated as income of the current year, but I can claim depreciation from 5 lakh because last year when I claimed deduction under 3580, there was no depreciation. Now, when you cancel 3580, I can reclaim depreciation. So that's regarding 3580. There is one more last point that when the expenditure on 3580 exceeds ₹10,000, payment shall be made by account pay check or draft or ECS. Cash expenditure, there is no deduction under 3580. Okay. Now we'll take a half an hour break and we'll continue. Section 35B, preliminary expenditure. That is the next deduction that is possible. Section 35B. Actually, the deduction for section 35B is allowed in 4 different steps. Okay. The first step is we have to calculate the actual expenditure. That is our first step. Before that, what is a preliminary expenditure? Preliminary expenditure means expense which is incurred before commencement of business. And it can also be expenditure which is incurred after commencement of business in relation to expansion of an existing organization. Okay, so it can be either incurred before commencement or after commencement for expanding your business. In both the cases, that will be called as preliminary expenditure. And preliminary expenditure, when we incur that, it's not just for a single year that we are incurring that expenditure. The benefit of the expenditure is spread over a future period. Hence, the expenditure is again divided over a number of years. It's allowed as deduction over a number of years. And that is what we call as amortization, where an expenditure is allowed as deduction over a number of years. See, we have something called as deferred revenue expenditure in accountancy, is it not? Deferred revenue expenditure. An expenditure which you have incurred and the benefits of which extend over more than 1 year, then that expenditure will be allowed as deduction over a specific period of years. The same logic here. Preliminary expenditure, even though you incur that before commencement, the benefit extends for a number of years. So deduction is also allowed over a specific period once the business is commenced. Okay. Now, deduction for preliminary expenditure is allowed in 4 different steps. Step 1, you have to find out the actual expenditure. Okay. Step 1, we have to find out the actual expenditure. Step 2, there is a maximum limit. The entire expenditure which you have incurred might not be allowed as deduction. There is a maximum limit for which you can claim the deduction. Step 3, by comparing step 1 and 2, we'll find out how much is the amount of expense that will qualify for deduction. See, there is a maximum limit. That means your deduction cannot exceed the maximum limit. So qualifying expenditure will be either step 1 or 2, whichever is lower. And the final step is we find out deduction per year, and deduction per year is 1/5 of the total qualifying expenditure. Okay, step 4 is finally we have to find out deduction per year, that is equal to 1/5 of qualifying expenditure. So these are the 4 steps in which we claim deduction for preliminary expense. First, we have to find out the actual expenditure. Then we have to find out the maximum limit. Maximum limit is higher of, we find out what is that maximum limit. Then we have to find out step 3, step 1 or 2, whichever is lower. And finally, we are finding out the qualifying expenditure will be allowed as deduction over a specific period. So we'll be finding out how much is deduction per year. Now, what is actual expenditure? Actual expenditure means only 6 expense. Any expenditure which is incurred before commencement is not called as preliminary. Any expenditure which is incurred before commencement of business is not called as preliminary expense. Only 6 different types of expenditure are called as preliminary expense. So what are the preliminary expenses? 1, expense on preparation of feasibility report, project report, some market survey, etc. That is the first item. Expenses on preparation of feasibility report, project report, market survey, etc. That is the first item. Second item is legal charges. See, legal charges for drafting agreement. Okay, legal charges for drafting agreement. Before commencing business, you may have to enter into agreements with certain persons. So those legal charges, that is the second item. Third one is legal charges for drafting memorandum of association and articles of association in case of a company. Fourth one, printing of memorandum and articles of association. Fifth one is the fees which you have to pay with the ROC for registering the company. And lastly, expenses in connection with public issue like underwriting commission, brokerage, issue of prospectus, etc. So only these 6 items will qualify for deduction. Any expense before commencement is not preliminary expense. Add together only these 6. It has been specifically given. Actual expenditure means is the word which they have used. So there is no scope for any, it's very clear. There is no scope for any doubt there. Okay, all these 6 expenses will together be called as preliminary expense. One is preparation of feasibility report, project report, market survey, making agreements, legal charges for drafting MA&A, printing charges, legal fee for registering company, and expenses in connection with public issue. One more thing, point number 3, 4, 5, and 6. 3, 4, 5, and 6 are applicable only to a company. 3, 4, 5, and 6 are applicable only to a company SSC. So for an SSC who is not a company, actual expenditure means only two types. One is preparation of feasibility report, and second one is legal charges for drafting agreement. Okay, so the first step is you have to find out the actual expenditure. Okay, second step is there is a maximum limit for which that can be claimed as deduction. And that maximum limit is either 5% of cost of project or 5% of capital employed, whichever is higher. That is, your expenses cannot exceed 5% of cost of project or 5% of capital employed. What is cost of project? Cost of project means sum total of assets. Sum total of fixed assets. Fixed assets on the as on the balance sheet date. That is as at the year end of as at the year end. Which year end? Year end in which the business is commenced. So business is commenced in 2023-24. Prepare a balance sheet as on 31st March 24 and find out how much is total of fixed assets. And sum total of fixed assets is called as cost of project. Okay, sum total of fixed assets is called as cost of project. Cost of project is sum total of fixed assets as on the last day of the financial year in which business is commenced. Okay, that is cost of project. Now, what is capital employed? Capital employed, go to the balance sheet as at the year end, add all your liabilities. Not all your liabilities. There are three liabilities to be added: share capital, debentures, and long-term borrowings. These three items added together, that is called as capital employed. Okay, so cost of project means sum total of fixed assets. Capital employed is items on the liabilities inside like share capital, debentures, and long-term borrowings. And again, if you're a SSC who is not a company, if you're a non-corporate SSC, non-corporate SSC will not have share capital, will not have debentures. So for a non-corporate SSC, we just consider cost of project. Capital employed is ignored. So the step 2 for a non-corporate SSC will be higher of 5% of cost of project. Now we have found out what is cost of project, what is capital employed. Cost of project is sum total of assets, that is asset side, fixed assets, and capital employed is sum total of liability like share capital, debentures, and long-term borrowings. Compare these two, take whichever is higher, apply 5%. Okay, apply 5%. Then step 1 or 2, compare. Whichever is lower is the qualifying expenditure. The qualifying expenditure is allowed as deduction over a period of 5 years. So let me explain this with an example. Suppose preliminary expenses, actual preliminary expense which is incurred by you is 60,000. Okay, so that is step 1. Step 1, we have found out preliminary expense. Now we have to find out step 2. Step 2 is the maximum limit. Step 2 is the maximum limit. For computing maximum limit, we have to compare cost of project and capital employed. Let us take that cost of project is 8 lakh. Okay, and capital employed is 10 lakhs. To choose whichever is higher, and that higher amount into 5%, which means 5% of 10 lakh. 5% of 10 lakh will come to 50,000. Okay, 50,000. So this is the maximum amount for which you can claim deduction. So step 3, find out qualifying expenditure. What is the amount for which you can claim deduction? Qualifying expenditure is 50,000. And step 4, deduction per year is, this 50,000 is allowed as deduction over 5 years. So deduction per year is 10,000. Okay, this is how we claim deduction. Deduction per year is 10,000. So first find out preliminary expense, which is equal to 60,000. Then there is a maximum limit. Maximum limit is either cost of project or capital employed, whichever is higher. So 10 lakh into 5%, 50,000. Step 3 is identify the qualifying expenditure. Qualifying expenditure is 60 or 50, whichever is lower, which comes to 50. Then deduction per year is 1/5 of that. So each year will be eligible to claim a deduction of 10,000. Okay. That is regarding preliminary expense. Now let us come to the next deduction. That's serial number 7. Altogether, I told you there are 22 deductions which we have to discuss. Serial number 7 is regarding 35 DDA, that is a deduction for VRS compensation. VRS compensation, when a company pays a VRS compensation, employer pays VRS compensation. Usually, huge amount of compensation is given to employee. So that amount of compensation is not allowed as deduction in a single year. Instead, it is allowed as a deduction over a period of 5 years. VRS compensation is allowed as deduction over a period of 5 years and is not allowed as expenditure in a single year. Okay. Now, point number 8, 9, and 10, that is regarding insurance premium. Insurance premium. The first item is regarding insurance premium of stock and stores. Insurance premium of raw material and work in progress is allowed as deduction under 3611. 3611A is insurance premium on life of cattle, which is owned by members of milk cooperative society. 3 types of insurance premium for which you can claim deduction. The next item of insurance premium is on health of employees. Employer is paying health insurance premium of employees. But one important point that you have to keep in mind is there is no deduction for payment which is made in cash. There is no deduction for payment which is made in cash. So these are the 3 types of insurance premium for which we can claim deduction. The first item is insurance premium paid on your stock. Second one is insurance premium which is paid on cattle by a milk cooperative society. Then there is insurance premium which is paid on the health of employees by an employer. But there is an extra point that the payment shall not be made in cash. If you make the payment in cash, there is no deduction for health insurance premium. Then 3612, bonus or commission which is paid to employees is also allowed as deduction, but that is subject to section 43B. I will explain what is 43B later. Maybe within 1 hour we'll be discussing 43B. So bonus or commission which is paid is also allowed as deduction, but subject to 43B. I'll explain that. Interest is also allowed as deduction. Interest which is taken for business purpose, whether that is taken for capital expenditure or meeting revenue expenditure. In either case, a loan is taken, interest is paid. It is business purpose, it is allowed as deduction. That is again subject to section 43B. Next item is discount on zero coupon bond. Discount on zero coupon bond. Zero coupon bond means zero interest. There is no interest there. Then what is the profit element for the investor? The bond is issued at a discount. Say bond is issued at a discount of 80 rupees and that is redeemed at either 100 or 110, the face value or premium. So 30 rupees you get profit when you redeem the bond. Okay, 30% is the profit which you get at the time of redemption of the bond. The investor gets a profit of 30 rupees. The issuer, the person who issues the bond, he has an expenditure of 30 rupees. And that 30 rupees is allowed as reduction over the life of the bond. It is allowed as reduction on pro rata basis over the life of the bond. Okay, pro rata basis. If 3 years is the life of the bond, 30 rupees is allowed as reduction over 3 years. If 30 rupees, 5 years is the life of the bond, then 30 rupees is allowed as reduction over a period of 5 years. So that is regarding bonus or commission, interest and discount on zero coupon bond. Okay, bonus or commission, interest and discount on zero coupon bond. Next one is employer's contribution to RPF, employer's contribution to superannuation fund. All these are allowed as business expenditure. But again, subject to section 43B, we'll see what is that. Employer's contribution. Employer contributes for the sake of employees. He may contribute to recognized provident fund and also approved superannuation fund. Employer's contribution to pension fund, that is also allowed as deduction, but there is a maximum limit. Employer's contribution to pension fund is also allowed as deduction, but there is a maximum limit, and that maximum limit is 10% of salary. Okay, maximum deduction is 10% of salary. Salary for this purpose means salary and DA, the terms the employment so provide, but salary does not include other allowances at perquisites. So employer's contribution to RPF, employer's contribution to superannuation fund, both are allowed as deduction, subject to 43B. Employer's contribution to pension scheme is also allowed as deduction, but there is a maximum limit, and that maximum limit is 10% of salary. Salary means salary plus DA provided by terms of employment. Then there is one more contribution, that is gratuity fund. What do you mean by a gratuity fund? The employer knows that after a period of 10 years, maybe 10 employees are they might retire from my organization after a period of 10 years. There are 10 employees who are due for retirement. So in the 10th year, I might need a huge amount of cash for paying them gratuity. 10th year, I need around 1 crore rupees in cash to pay them gratuity. So what the employer thinks is, he invests certain amount of money in a specific fund. He invests certain amount of money in a specific fund. Each year, maybe he might be depositing some around 7 lakh or 8 lakh. The 7 lakh or 8 lakh gets accumulated over a period of 10 years. And by the end of the 10th year, he might have that huge amount in this account, in that investment account. So the amount which is transferred, actually that represents not an expenditure, but that is an investment which is made by the employer. Amount contributed to gratuity fund, that is an investment. That doesn't come in P&L account. It's not an expenditure. But Income Tax Act says that you can claim deduction for the amount which you contribute now. That amount of 7 lakh or 8 lakh which you set aside towards that investment activity is also allowed as deduction. So point number 14, 15, and 16 are all regarding employer's contribution. Okay. 14, 15, and 16 are all regarding employer's contribution. 14 is regarding employer's contribution to RPF and approved superannuation fund. Point number 15 is regarding employer's contribution to pension scheme. And point number 16 is employer's contribution to gratuity fund. Everything employer. Now, point number 17 is regarding employee's contribution. Okay. Point number 17 is regarding employee's contribution. Employee's contribution to staff welfare scheme. The employer collects 100 rupees from employee's salary. Employer collects 100 rupees from employee's salary for the purpose of contribution to PF. And this employer has to deposit that 100 rupees to the employee's account. But this amount has to be deposited immediately the date mentioned in the staff welfare scheme. The PF and ESI payments, they say that PF and ESI payment, any amount collected from the employee has to be deposited before the 15th of next month. From April salary, when I deduct 100 rupees from employee, I have to deposit that to employee's account. The employer has to deposit that to the employee's account before 15th May. May salary I collect 100, it has to be deposited in employee's account before 15th June. June salary I collect 100 rupees, it has to be deposited in employee's account before 15th July. Okay. So it has to be deposited in the employee's account before the 15th of next month. Only if the employer deposits that before the 15th, it will be allowed as deduction. Otherwise, it will not be allowed as deduction. So once you collect money from employee, you cannot retain that with you. You cannot retain that with you. That is what this section says. Once you collect money from employee, employee should not retain it. Employee should not take it to his pocket. He has to deposit that immediately, and immediate is 15th before the next month. Then that will be allowed as deduction. If the 100 rupees collected from the employee is not deposited before 15th of next month, that 100 rupees will not be allowed as expenditure. 100 rupees as well. Okay, that is regarding employees. See, the earlier three were employer's contribution. This is employee's contribution. Point number 18, write-off of allowance for animals. Write-off of allowance for animals. The employer is using animals for the purpose of his business. Animals for the purpose of his business. So maybe the employer has a horse cart. He has purchased a horse. Okay, he has a horse cart and he rides a horse when he comes to office. The horse was purchased for 80,000 rupees. The year in which the horse is purchased, there is no deduction. It is not allowed as expenditure, but it is allowed as expenditure in the year in which the horse dies or it becomes useless. Horse dies 2 years later, 80,000 will be allowed as deduction the year in which animal dies, in the year in which the horse dies. Okay, so that is regarding write-off of allowance for animals. In the year of purchase, there is no deduction on purchase of animal. but in the year in which animal dies, or in the year in which animal becomes useless, or in the year in which animal is sold, the profit or loss on sale will be treated as expenditure of profit. Same example, suppose this horse purchased for 80,000 is sold at 20,000. Okay, after 2 years, the horse is sold for 20,000. Then 60,000 will be allowed as expenditure in the year of sale of that animal. This is regarding animals. I'm not talking about animals purchased as stock in trade. I'm talking about animals which are used in business. Then 3617, that is regarding bad debts. Bad debts. If you want to claim deduction for bad debt, it has to be treated as income of the current year or the earlier year. Only an income on which you have already paid taxes will be treated as expenditure later. So the bad debts usually relate to credit sales. The credit sale shall be earlier credited in P&L account. You have paid taxes on that that credit sale. Later, when you realize that you are not able to recover that money, it can be allowed as deduction. Mere provision is not sufficient, but actual write-off is required. When you create a provision for doubtful debts, creating a provision for doubtful debts is not sufficient. The bad debt has to be actually written off. Bad debt has to be actually written off. However, for SSC carrying on banking business, we can claim deduction for provision for doubtful debts. Okay, SSC carrying on banking business. Anyway, we might not be having a banking company calculation. We are doing only calculation for individuals. So I'm not explaining point number C. Okay, that is relating to persons engaged in banking business. So normally you and me cannot claim deduction for provision for doubtful debts created. We can claim deduction for only actual bad debts, but a banking company can claim deduction for provision created because it's statutory under the RBI regulations. So that is regarding bad debt. If you and me want to claim deduction for bad debt, it has to be actually written off in the books of accounts. Provision created will not be allowed as expenditure because provision is just a book entry. You cannot call that an expenditure. So provision when you create, that is not allowed as deduction. Banking company, if they create provision, that is allowed as deduction. 3619, family planning expenditure. 3619, family planning expenditure. Family planning expenditure, the deduction is allowed only for companies. Deduction is allowed only for companies. Deduction is there only for revenue expenditure. Revenue expenditure is allowed as deduction in the same year itself. Capital expenditure is allowed as deduction over a period of 5 years. Capital expenditure is allowed as deduction over a period of 5 years. And if there is an unabsorbed capital expenditure, which meaning there is a loss as a result of capital expenditure on family planning, we deducted capital expenditure on family planning, and as a result of which there is a loss. Such loss will be carried forward as if it is an unabsorbed depreciation. So it can be carried forward for an unlimited number of years. Okay. Then the next two sections are relating to STT and CTT. STT means Security Transaction Tax, the tax which you pay in stock exchanges on purchase and sale of securities. CTT is the Commodities Transaction Tax. Again, you pay it in commodity exchange on purchase and sale of these commodities. Both STT and CTT is allowed as expenditure. Amount of reduction is actual amount paid. So these are, when we started claiming deduction, we had mentioned that there are specific deductions from 30 to 36. These are the specific deductions we have discussed so far. Okay, these are the specific deductions we have discussed. Now there is a general deduction, and general deduction is given under section 37. Okay, general deduction is given under section 37. That general deduction is for any other revenue expenditure. Any other revenue expenditure which is wholly related to business and which is not specified under section 30 to 36. Any other revenue expenditure can be claimed as deduction. Salary, traveling expenditure, office expenditure, electricity charges, all these we claim deduction under section 37. But there is no deduction for expenditure which is incurred in relation to an offense. In relation to an offense, like you pay fine or penalty under any act. Fine or penalty which is paid under any act is not allowed as deduction, because the fine or penalty you pay as a result of some offense which you have committed, for which there is no deduction. Also, CSR expenditure which is incurred as per the provisions of Companies Act, that is also not allowed as deduction under Income Tax Act. You may be spending CSR expenditure, but that is not allowed as deduction. There are two circulars. One is circular number 762 and the other one is circular number 5. Okay. Circular number 762 says that Keyman insurance policy which is paid by a partnership firm on partner is allowed as expenditure. And circular number 5 says that the pharmaceutical companies, when they pay freebies to doctors and other medical practitioners, any incentives which are given by pharmaceutical companies, it is not allowed as expenditure. Okay. So these are the two circulars. Keyman insurance policy is allowed as deduction, whereas freebies provided to medical practitioners is not allowed as deduction. 37(2)(b) says that advertisement expenditure is no doubt, that is business expenditure, but there is no deduction for business expenditure incurred in souvenir or brochure or tract or pamphlet of a political party. Okay, political party is issuing some souvenirs. You are giving advertisement in that souvenir. There is no deduction for the expenditure which you have incurred in that case. And point number 38, where an asset is partly used for business, only depreciation relating to official use can be deducted from the block to arrive at the WDV for the next year. Say a motor car is used for official purpose as well as personal purpose. Motor car is used for official purpose as well as personal purpose. Now, depreciation relating to motor car, 80% is used for official, 20% is used for personal. Only 80% of depreciation will be deducted to arrive at the return down value for the next year. These are all deductions which we have discussed, the allowable deductions. Now, when we discuss about deductions, simultaneously, we also have to discuss about expenses which are not allowable. Expenses which cannot be debited in P&L account. Okay, expenses which cannot be debited in P&L account. We know that when you are making some payment, there is something called as TDS, tax deducted at source. TDS is a tax which is paid by the payer, on and behalf of recipient. Okay, on and behalf of recipient. It is a tax which is paid by payer and that is paid on and behalf of recipient. So when a person makes payment of 1 lakh to a person, A makes payment of 1 lakh to B, A will not pay the entire amount of 1 lakh. Instead, A will deduct TDS, say 10%, 10,000, and only 90,000 gets credited in B's account. Only 90,000 gets credited in B's account. Okay. 1 lakh is the actual amount which is due, but only 90,000 gets credited. If a person fails to, if Mr. A, the payer, fails to deduct TDS, then the amount of 1 lakh which is paid to Mr. B, which is otherwise a pure business expenditure, is not allowed as deduction. If he fails to deduct TDS, if Mr. A, when he makes payment to Mr. B, if he fails to deduct TDS, then the TDS will not be allowed as expenditure will not be allowed as deduction for Mr. A. Okay. Now let us see that Mr. A deducted 10,000. He paid only 90,000 to Mr. B. What is another obligation which Mr. A has to do? Another obligation which A has to take care of. Mr. A has to deposit this 10,000 to Income Tax Department. Okay. Mr. A has to deposit this 10,000 to Income Tax Department. And this 10,000 has to be deposited before the due date of filing return of income. That is before 31st July of the next year. Before 31st July of the next year, Mr. A has to make payment of 10,000 to the Income Tax Department. So there are two obligations on Mr. A. One, he has to deduct TDS. Second, he has to deposit that TDS. Deduct TDS and deposit TDS. If he fails to do any of these, if Mr. A fails to do any of these, either he fails to deduct TDS or he fails to pay deposit TDS, then the expenditure is not allowed as deduction. So let us see what are the provisions relating to this non-deduction of TDS and all. 40A1 is the first section in which TDS, 40A1 is the first section in which expenditure is disallowed. But this 40A1 is applicable to three items: interest, royalty, and fees for technical service. Interest, royalty, and fees for technical service. These three expenditure are either paid outside India or it is paid in India to a non-resident. Let me call this a foreign payment then. Let me call this a foreign payment because it is either paid outside India or it is paid to a non-resident. So either paid outside, either paid in foreign country or paid to a foreigner. Now either way, let me call that for the, simply let me call that foreign payment. This foreign payment, so we paid interest to NRI, 1 lakh. TDS is not deducted. 1 lakh is not expenditure. 1 lakh is actually relating to business. That is not allowed as expenditure. Okay, that is point number 1. But this year you failed to deduct TDS. But the mistake which you committed in this year, that is corrected in the next year. Next year you deducted TDS and paid that amount to income tax department, all interest, everything extra paid. So you made good that loss. The loss happened to income tax department is made good in the next year. That is compensated in the next year. Then you can claim deduction the next year. This year I will disallow the expenditure. Next year I will allow the expenditure. Okay. The mistake which is committed is made good by you in the next year. Next year will be allowed as deduction. Point number 3. Point number 3. Expenditure disallowed in the current year. Expenditure is disallowed in the current year. But this mistake is made good by the recipient. Recipient paid taxes. Recipient paid taxes on the entire amount of 1 lakh. Okay. Recipient paid taxes on the entire amount of 1 lakh. That is a mistake committed by the payer is compensated by the recipient. Then it will be allowed as deduction to the payer in the next year. That is whenever that recipient makes good that loss. Recipient has paid taxes, then no problem. Then there will be no penalty for the payer. So these are the 3 cases. Let us see the first point. This is allowed. This is applicable to foreign payments. Foreign payments are made, but TDS is not deducted or deducted TDS is not deposited. In either case, the 3 items are not allowed as expense. But expense which is allowed as, which is disallowed in the current year will be allowed as deduction the next year if the correction is made, the mistake is corrected in the next year. Also, the expenditure which is disallowed in the year will be allowed as deduction the next year if the recipient pays all the taxes. 40A1A is similar, but the difference is this covers resident payments. That is the first difference. Second, if 1 lakh is paid without tax deduction, 1 lakh is not disallowed. Only 30% of the expenditure is disallowed. Only 30% of the expenditure is disallowed. Okay. If 2 lakh is paid without tax deduction or without deposit, 60,000 is disallowed. Not the entire amount. Foreign payments, we disallow the entire amount. But resident payments, we disallow only 30%. (48)(2). Wealth tax is not an expenditure. Wealth tax is not in force now. That act has been abolished. So I'm not talking about that. Income tax is not an expenditure. The reason might be that income tax is only an appropriation. What is the difference between expenditure and appropriation? Expenditure means you have to pay that whether there is profit or loss. That is what is called as expenditure. Appropriation means you pay that amount only if there is profit. Only if there is profit, you pay it. That is what is called as appropriation. But expenditure is you have to pay it whether there is profit or loss. Income tax is a tax which you pay only if you have profit. If you have no profit, there is no income tax. So income tax is not an expenditure, it is an appropriation. If it is not an expenditure, it is not allowed as deduction. Whereas GST is an expenditure. GST is an expenditure because because GST you have to pay on turnover, whether or not you have profit. So GST is an expenditure, income tax is not an expenditure. 48(2)(b). You're making payment to an NRI for specified service. The specified service here is online advertisement service. You are making payment to an NRI for online advertisement service. It is not allowed as deduction. Again, if you don't deduct equalization levy, it's something similar to TDS. If you don't deduct equalization levy or the deducted levy is not deposited. All right. 48(2)(c). The state government charging license fee from state government undertaking, or a state government undertaking paying license fee to state government. It's an organization which is owned by government. The undertaking, the organization paying tax to its own honor in a way. So there is no deduction for such royalty and license fee which is paid by state government undertaking to state government. 48(3). Salary paid to an NRI. Earlier we had talked about interest, royalty or FTS paid to NRI. Here it is salary paid to NRI is also not allowed as deduction if TDS is not deducted or deducted TDS is not deposited. Similarly, when an employer makes contribution to Provident Fund of the employee, make sure that when lump sum is paid at the time of retirement, the all arrangements have been made for deduction of TDS. All arrangements are made for deduction of TDS when lump sum is paid at the time of retirement. If such arrangements are not made, then again, the contribution to Provident Fund will not be allowed as deduction. F5, tax paid on non-monetary perquisite. Tax paid on non-monetary perquisite by the employer is also not allowed as deduction. Tax paid on non-monetary perquisite. So all these provisions which we have discussed were something or not related to tax, related to income tax in one form or the other, TDS, equalization levy, then Provident Fund contribution, whether TDS have been deposited, TDS arrangements have been made for deduction of TDS. Everything was in one form or other relating to tax, and the deduction is allowed only if TDS is deducted or TDS deducted is deposited before the due date. Now 40B is something different. This is applicable to a partnership firm. 40B is applicable to a partnership firm. See, when we talk about a partner and a partnership firm, they are very much related to each other, is it not? Partner is a very close associate of a partnership firm. So they might arrange their transactions in such a way that neither the partner nor the firm pays any taxes. They can pay huge amount of salary or huge amount of interest to their own partners. A firm may pay huge amount of salary or huge amount of interest to their own partners so as to reduce the tax liability. So we have kept a limit upon the total amount of salary or interest which can be paid to a partner. Okay, interest can be paid to partners only up to a maximum of 12%. The maximum interest which can be paid by a partnership firm to a partner is only 12%. The partnership deed might provide for a payment of 15% or 20% or any other rate, but Income Tax Act permits only 12% to be written in P&L account of a partnership firm. Similarly, remuneration, salary, there is a limit. First point is salary shall be paid only to working partners. Salary shall be paid only to working partner. Any salary paid to a sleeping partner is not allowed as deduction. Salary which is paid to a sleeping partner is not allowed as deduction. So let us see what is deduction for salary paid to working partners. Salary paid to working partners, we have to first find out book profit. And what is book profit? Book profit means net profit as per P&L account. Okay, net profit as per P&L account. Adjust all those disallowances or allowances which we have so far discussed, like scientific research expense can be deducted, then depreciation is to be deducted, commodities transaction has to be deducted, disallowances, if TDS is not deducted, the expenditure has to be disallowed. So all those adjustments which we have discussed so far under section 28 to 44D, that has to be made with the net profit. And also add back remuneration to partners if it is already debited in P&L account. Okay, remuneration to partners if it is already debited in P&L account, that is also to be added back. And the amount which you get after making all these adjustments, that is called as book profit. The amount which you get after making all these adjustments is called as book profit. Identify the book profit. 3 lakh of book profit. For a book profit up to 3 lakh, the amount of deduction permissible is 90% of book profit or 1,50,000, whichever is higher. For the balance, you can claim a deduction of 60%. I'll explain with an example. First of all, let us identify all those limits and percentages. Up to 3 lakh, 90% or 1,50,000, whichever is higher. On the balance, 60%. Okay. Again, interest and remuneration will be allowed as deduction only if 2 conditions are satisfied. It has to be authorized by the partnership deed. There has to be a specific clause in the partnership deed which provides for payment of interest. There has to be a specific clause in the partnership deed that provides for payment of interest. Also, that interest and remuneration, both interest and remuneration, there should be a specific clause. And it shall relate to a period after the date of partnership deed. What does that mean? The partnership deed is made from 1st August. You can claim deduction only for interest and salary which is paid from 1st August. Interest or salary, if any, paid from April to July, April, May, June, July, 4 months, interest and salary will not be allowed as deduction. So now let me explain how do we calculate remuneration to working partners. What is the deduction for remuneration to working partners? Let us assume that book profit of a firm is, book profit means after making all adjustments. Okay, after making all adjustments, and if remuneration has already been debited to P&L account, again add that back. That amount is called as book profit because we are deducting something else here. We are deducting some other amount here. So book profit is 7 lakh. Book profit is 7 lakh. All adjustments have been made except remuneration. Even interest paid in excess of 12% is added back. So now the firm has a book profit of 7 lakh. Of these 7 lakh, up to 3 lakh, divide 7 lakh into 3 lakh. First 3 lakh and balance. On the first 3 lakh, you can claim a deduction of 7 lakh into 90% or 1,50,000, whichever is higher. 7 lakh into 90%, sorry, not 7 lakh, 3 lakh into 90%, up to 3 lakh. From 3 lakh, from 7 lakh, take the first 3 lakh, first 3 lakh. On that 3 lakh, we can claim up to 90%. 3 lakh into 90% or 1,50,000, whichever is higher. 3 lakh into 90% means 2,70,000 or 1,50,000, whichever is higher. So we will take here 2,70,000. Okay. On balance book profit. How much is balance book profit? Balance book profit is now 4 lakh. In 7 lakh, we have already calculated what is remuneration that can be paid up to 3 lakh. For making a profit of 3 lakh, firm can pay 90% remuneration. On the balance book profit is 4 lakh. You can give a remuneration of only 60%. You can give a remuneration of only 60%. 4 lakh into 60% is equal to 2,40,000. 2,40,000. So total is 5,10,000 is the maximum remuneration which can be paid. Maximum remuneration. Maximum remuneration which can be paid to all partners of the firm together, all partners. And partners here means only working partners. Remuneration paid to working partners is only allowed as deduction. So the maximum remuneration possible is 5,10,000. So first of all, identify book profit. Book profit means the net profit. Make all the adjustments discussed under the head business except remuneration. That is, remuneration that is already debited, add that back because we cannot give deduction for that remuneration which is debited in P&L account. We may be calculating a new amount here, a fresh amount. And divide that 7 lakh into 2 portions. The first 3 lakh. For the first 3 lakh, the amount of remuneration that can be allowed is 3 lakh into 90% or 1,50,000, whichever is higher. That is 2,70,000 or 1,50,000. And balance is 4 lakh. For that, we can claim 60%, 2,40,000. total remuneration for a 7 lakh book profit which can be paid is only 5 lakh 10,000. For a 7 lakh book profit, we can give a remuneration of only 5 lakh 10,000. Okay. One question. What if the book profit is in negative? If it is loss, book profit is negative. After making all other adjustments, we have a negative figure. Can we claim any deduction for remuneration in that case? Can we claim any deduction for remuneration in that case? Book profit is negative. Let us take book profit is minus 2 lakh. Book profit is minus 2 lakh. Can we give any remuneration to partners in this case? Can any remuneration paid be allowed as deduction in this case? Let us see. Up to 3 lakh, it is 3 lakh of, 90% of 3 lakh, 90% of minus 2 lakh, 0, or 1 lakh 50, whichever is higher. Whichever is higher. So the maximum possible remuneration is 1 lakh 50, even if the firm is in a loss. Even if the partnership firm is in a loss, you can give a salary of 1 lakh 50 to your partner. Okay. So loss-making partnership firm. Loss means book profit should be in loss. Okay. Not the net profit as per P&L account. I'm talking about the book profit. If book profit is in negative, the maximum possible remuneration is 1 lakh 50,000. Okay. 40BA. AOP or BOI, if they are paying any interest, salary, bonus, commission, or remuneration to their members, that is not allowed as expenditure. A partnership firm, if they pay salary or interest to their partner, there was a limit up to which you can claim deduction. You could have claimed deduction up to 90%, 60%, and all that. If it is interest, it is 12% and all that. But an AOP or a BOI, if they pay any salary, interest, bonus, commission, or remuneration, there is no deduction. 48.2, very much important. 48.2 and 48.3, every question of business will have an adjustment on this. 48.2 and 48.3. 48.2 says that any payment which is made to relative, which is excessive and unreasonable when compared to market value, is not allowed as deduction. Okay, you have a relative working in your organization. Relative. And that relative is paid a salary of 8 lakh per annum. Whereas, if the person had not been your relative, the market value is the salary which you have paid would be only 5 lakh. If you're taking a person other than your relative in your organization, you would pay only 5 lakh. But since this person is a relative, you have paid 8 lakh as salary. That excess paid 3 lakh will not be allowed as expenditure. Excess 3 lakh is not allowed as expenditure. 48.3, expenditure in excess of 10,000, which is made to a person in a day, otherwise than by account paycheck, is not allowed. Single day, single person, you are paying more than 10,000 in cash. Single day, single person, you are paying more than 10,000 in cash. That expenditure is not allowed. But the limit is 35,000 for transporter, because a transporter who is coming all the way from Haryana or Jammu and Kashmir, he may have to incur huge amount. Is it not? You may have to incur huge en route expenditure. On the way back, he will have to fill in petrol and diesel. There might be some problem with the tire. And so we allow excess cash payment possible for a freight that is 35,000. Retirement benefit can be paid in cash up to 50,000. So these are the 3 limits. Retirement benefits can be paid up to 50,000. Transporter can be paid 35,000 in cash on a single day. And other payments you can make only 10,000 in cash on a single day. But there are a lot of exceptions under Rule 6VD. In certain cases, even if you make payment in cash, that is not disallowed. For whom you can make payment in cash? You can make payment in cash to bank. You can make payment in cash to government, to the cultivators, to the agents, and also an authorized money changer. He can make payment in cash to a person who sells foreign currency. Okay, so these are the few cases where payment can be made in cash, but there is no disallowance. Payment is made to bank, like you have taken a loan, and the interest on a loan you are paying back. Interest on loan is you are paying to the bank. That interest is paid in cash. No problem. That is allowed as expenditure. Government. You are making payment to government. Okay, you are making payment to government. Municipal taxes you are paying. Huge amount. Municipal taxes you are required to pay 1 lakh today. Today is the last date for remittance and they accept only in cash. They say that they are accepting only in cash. You can make payment to government. No problem. There is no disallowance. Similarly, cultivators, you can make the payment in cash. Agents, you can make the payment in cash. And an authorized money changer can also make payment in cash. 48.3a. 48.3a says that last year, I created a liability in my books of accounts. I created a provision in my books of accounts, like salary to salary payable. 50,000 was created as liability last year, 22-23. 22-23 financial year, salary account to salary payable. And I claimed 100% reduction for that expenditure because it was not paid in cash. Salary to salary payable, 50,000 was allowed as deduction. 23-24, what I did that, salary payable to cash, I paid that 50,000 in cash. 23-24. So the amount that was allowed as reduction 22-23 will be disallowed in 23-24. Okay. You have claimed deduction for an expenditure which is incurred on the basis of a liability. There was no payment made in 22-23. 22-23, there is just a book entry, salary accounted to salary payable, allowed as deduction. Next year, salary payable to cash, that was made in cash on a single day exceeding 10,000. Next year, that will be disallowed or it will be added to income. 48.4, no person can file a suit that there was an agreement for making payment in cash. Later on, that agreement was broken and the party made payment in check. You cannot file a suit that that agreement has been broken. That case is not valid. 48.7, contribution to unapproved gratuity fund is not allowed as deduction. Earlier, we had explained that only the contribution to approved gratuity fund is allowed as deduction. So contribution to unapproved gratuity fund is not allowed. So also contribution to non-statutory funds like URPF is not allowed as deduction. Contribution to non-statutory funds is also not allowed. Now section 43B. 43B is a section that is applicable to those persons who are following. 43B is a section that is applicable to those persons who are following mercantile system of accounting. Mercantile system of accounting. So you have created a liability in your books of accounts and you have claimed deduction for that. You have created a liability in your books of accounts and you have claimed deduction. Later on, it is identified that that liability which you have created in the books of accounts is all fake. That is just book entries. You are recording an entry like municipal tax to municipal tax payable 5 lakh. That is not paid. Next year also you are making a journal entry municipal tax to municipal tax payable another 8 lakh. Again, that is not paid. So what do you understand from that? These provisions which you have created, they don't represent your actual expenditure. So we made a rule that certain expenses, if you make provision in your books of accounts, that is not allowed as expenditure. Even though you are following mercantile system of accounting, certain expense, if you create provision in your books of accounts, that is not allowed as expenditure. Instead, the provision so created has to be paid off before the due date of filing return of income. Let me give you an example. I have created a provision for municipal tax. Municipal tax, I have created a provision for 5 lakh on 31st March 24. Since I am following mercantile system of accounting, I can very well do that. So I have created a provision in 2023-24. This will be allowed as expenditure. I will allow you to write this amount in the P&L account only if this 5 lakh is paid before 31st July 2024. That is the due date of filing return of income. Of course, if you are a person who is governed by compulsory audit, then your due date will be 31st October 2024, whatever is the case. If you have no audit, 31st July. If you are in audit, 31st October. So make sure that 5 lakh is paid before 31st July or 31st October as the case may be. Before 31st July or 31st October. Then only 5 lakh is allowed as deduction in 23-24. Because your P&L account contains that expenditure of 5 lakh, but that is not paid. So I'll have to look into the balance sheet as well. I look into the balance sheet, the municipal tax payable is there on 31st March 24, and I will go to the ledger of 2024-25, current year 24-25, and see whether it is paid before 31st July. If it is not paid before 31st July, this 5 lakh debited in P&L account will not be allowed as expenditure. I will disallow this. And next year, if you make payment, that is make payment after 31st July or 31st October, that is you paid only on 31st December 2024. Okay, you paid only on 31st December 24. To 23-24, it is disallowed. 23-24, it is disallowed. And 24-25, it is allowed. 24-25, it is allowed. Okay, 23-24, you disallow 5 lakh. 24-25, you allow 5 lakh. This is how Section 43B functions. If it is paid before 31st July, it is allowed in 23-24 itself. If it is paid before 31st July, it is allowed in 23-24 itself. If it is paid after 31st July, it is allowed in the year in which it is actually paid. So what are the various types of expenditure that are governed by this section? Not all expenses are governed by 43B, not all. Only 7 items. 7 items are governed by this section: A, B, C, D, E, F, and G. Okay, 7 items. And point number G is an amendment that has been introduced from assessment year 24-25. I will explain that separately. Let me first explain A, B, C, D, E, and F. 6 items. These 6 items will be allowed as deduction only if payment is made before due date of filing return of income. Now, which are those 7 items? 1, any cess, tax, duty, fee payable to government. Government payments. Any cess, tax, duty, fee payable to government. Point number B. What is next point? Point number B is. Point number B. What is point number B? Bonus or commission which is payable to employees. Bonus or commission which is payable to employees. Okay, that is second item. Bonus or commission which is payable to employees. Third one is interest on loan taken from bank, paid before the due date, then only it will be allowed as deduction. Leave salary also paid before the due date, then only it will be allowed as deduction. Indian Railways, payment to Indian Railways for use of asset, that also you have to pay the due before the due date of filing return of income. So these are the 6 items which will be allowed as deduction only, which will be allowed as deduction only if payment is made before due date. The various expenses are cess, tax, duty, fee payable to government, employers' contribution to provident fund, bonus or commission to employees, interest on loan taken from bank and other financial institutions, leave salary, and payment to Indian Railways for use of railway asset. Okay, now let us come to point number G. Point number G is slightly different, and this has been introduced from assessment year 24-25. We have a question on RTP May 24 on this. We will do that also simultaneously. Let me first explain what is point number G. Point number G. Point number G is applicable, and this section was introduced. The objective behind the introduction of this section was to protect the micro and small enterprises. Micro and small enterprises as defined under MSME Act. Okay, micro and small enterprises are defined under MSME Act. So the objective of the section was to protect these micro and small enterprises. Many a time, what happens is, a person, he purchases from a micro and small enterprise, but the payment is made after a huge delay. Payment to these persons is delayed. So these persons, they are very small organizations. So their cash flow will be very much affected if they don't receive their money promptly. They don't receive money promptly. Okay. So in order to protect their interests, the government says that when you purchase from a micro or small enterprise, we would have recorded a journal entry, purchases account debtor, to Micro enterprise. Micro enterprise. Okay, that is a journal entry. And this journal entry is recorded, let us say this is recorded on 15th March 2024. And the purchases will appear in the P&L account of 2023-24. Purchases will appear in the P&L account of 2023-24. Now the income tax says, if you have an agreement with a micro small enterprise, if you have an agreement with a micro or small enterprise, make payment within that date mentioned in the agreement. But the maximum period of agreement can only be 45 days. Even if your agreement says that payment will be made after 60 days, you have to make payment within 45 days. Okay, if there is no agreement with the micro and small enterprise, payment has to be made within 15 days. And if you fail to make payment within this period of 45 days or 15 days, deduction will not be allowed. So let me again explain. Let me explain a case where there is an agreement with MSME, micro and small enterprise. There is an agreement. And the agreement says that the payment has to be made within 45 days. Even if it says 60 days, we'll take only 45. The maximum time limit which can be permitted in the agreement is only 45 days. So you have to make payment within 45 days if the expenditure has to be allowed as deduction in 23-24. If the expenditure has to be allowed as deduction in 23-24, you have to make payment within 45 days. So let us assume that payment is made on 5th April 2024. That is, payment is made within a period of 45 days. So this will be allowed as deduction in 2023-24 itself. Allowed in 23-24. Do you understand? Now let us take another example. Payment is made on 5th May 24. 5th May 24. That is not within 1.5 months. 45 days means it is around 1.5 months. So the payment is made only on 5th May 24. So what will be the rule then? It will be disallowed in 23-24 and allowed in 24-25. When you make payment, it will be allowed as deduction. If you don't make payment to a micro and small enterprise in time, that is not allowed as deduction. And what is the time? 45 days in case there is an agreement, 15 days if there is no agreement. Okay. 15 days if there is agreement, 45 days. 45 days if there is agreement, 15 days if there is no agreement. If you make payment within this time, you can claim deduction the year in which you record the expenditure. You make a provision. Okay. So these are applicable only with respect of credit purchases or whatever, not just purchase, any payment made to credit services as well. So credit purchase will be allowed as deduction in the year of purchase only if payment is made within 45 days or 15 days as the case may be. 45 days if there is an agreement, 15 days if there is no agreement. Okay. And if you make payment within that period, you can claim deduction the year in which you record the credit purchase. On the other hand, if you don't make payment within a period of 45 days or 15 days, you can claim deduction only in the year in which you make payment. Okay. So we have a question upon this in RTP May 24. RTP May 24. Let us take that. (43B) provisions are applicable only to micro and small enterprises. These are not applicable to medium enterprise. Okay, micro and small enterprise as defined by MSME Act. So this is the question. This is from RTP May 24. Anil started a business of manufacturing tables in February 2024. He follows mercantile system of accounting. He is purchasing goods from A, B, and C. Details of purchases and payments are as follows. Buyer is You are buying from Mr. A, Mr. B, and Mr. A medium enterprise. A and B are micro and small. Media enterprise is not governed by 43B. So even if you fail to make payment, you can claim deduction the year in which you book the journal entry. So no problem. You can claim this deduction. So medium enterprise anyway, 8 lakh. 8 lakh, whether you make payment or you don't make payment, you can claim it as deduction in the year in which you record the credit purchase. You can claim deduction the year in which you record the credit purchase. So medium enterprise is not governed by the section. See, the purchase was made in 25/3 and the payment was made only in November. No problem. I'll give you deduction the year in which you have made the purchase. That is 8 lakh will be allowed as deduction 23-24. Let us compare the first two items, micro and small enterprise. Micro enterprise, 15 to 24 was the year in which you have made the purchase. Purchase amount is 5 lakh. The agreement provided to make payment within a period of 30 days. Within a period of 30 days means, around, we have to make payment on 15th March 24, 15th March. Okay. If payment is made before 15th March, deduction can be claimed in the year in which you have recorded the entry. You have recorded the purchase entry. But if payment is made after that, the payment deduction can be claimed only in the year of payment. But unfortunately, in this question, the year of purchase entry and the year of payment both fall in the same year. Is it not? Year of purchase is 23-24. Year of payment is also 23-24. So whether you pay within 45 days or 15 days or not, you can claim deduction the year of payment. So if both year of purchase and year of payment fall in the same financial year, you need not look into that 45 days or 15 days criteria. When both date of purchase and date of payment fall in the same financial year, there is no problem whether you pay it within 45 days or 15 days. Only when the payment jumps across the next financial year, you have to see whether payment has been made within 45 days or not. Okay. So in this case, ideally, payment should have been made within 30 days, but since payment has been made in the same financial year, deduction can be claimed in the same financial year. So 5 lakh is allowed as deduction. 5 lakh is also allowed as deduction. 8 lakh is also allowed as deduction. Understood? 5 and 8, both allowed as deduction. Now let us take Mr. B. Mr. B, the purchase was made on 17th March. There is no return agreement. Since there is no return agreement, payment has to be made within 15 days. 17 plus 15 will come to around April 1. April 1, 24. If you make payment before April 1, 24, you can claim it as reduction in 23-24. If you make payment before April 1, 24, you can claim reduction in 23-24. But if you make payment after that, you can claim reduction only in the year of payment. Here, the payment is not made within 15 days. So you can claim deduction only in the year of payment. Year of payment is 24-25. So 7 lakh is not allowed as deduction in 23-24. Okay. So the amount of deduction possible here is 13 lakh. 13 lakh is the answer. 13 lakh. So I repeat, when both year of payment and year of provision, year of credit and year of payment falls in the same financial year, there is no problem under MSME, whether you make payment within 45 days or 15 days or after that. If both fall in the same financial year. But if the financial year changes, payment is made in a different financial year, then you have to look into that 45 days or 15 days criteria. So section 43B is over. All the inadmissible expenditure is over. Okay. Deemed profits, section 41. Deemed means these are strictly speaking, these are not business profit, but we will treat this as business profit for the purpose of income tax. We will treat this as business profit for the purpose of income tax. What are they? One is recovery against deduction allowed earlier. Recovery against deduction allowed earlier. What does that mean? Last year, my stock was destroyed by fire. Last year, my stock was destroyed by fire. there was a fire and my stock was destroyed. That is a business loss. So around 8 lakh worth stock was destroyed. 8 lakh was allowed as deduction in 2022-23. Okay, 8 lakh was allowed as deduction in 2022-23. What happened in 23-24? I had taken an insurance policy. So the insurance company admitted a claim of 5 lakh. They gave me an amount of 5 lakh. Insurance company. There is a recovery towards a deduction allowed earlier. Towards a deduction of 8 lakh, I am getting now 5 lakh. So when you receive that 5 lakh now, 5 lakh will be treated as business income. Okay, when you receive 5 lakh now, 5 lakh will be treated as business income. So this is the case regarding deemed profits. Last year, I was allowed an expenditure. Towards that expenditure, now I am receiving money. So when I receive money, that will be treated as business income. Same is the logic regarding point number 4, recovery of bad debts. Last year, bad debts was allowed as deduction. Last year. This year, I am receiving money towards that bad debt. Bad debts recovered, it will be treated as income. Balancing charge we have already seen. Power sector units having straight line method of depreciation. If they sell their asset on the straight line method of depreciation is charged, then the amount of deduction allowed, profit up to the amount of deduction allowed is treated as balancing charge. Point number 3, there is an asset which was purchased for scientific research. An asset which was purchased for scientific research. When you purchase an asset for scientific research, we claim 100% deduction. And towards that asset, when that asset is subsequently sold, you get some money. The money which is received will be treated as business income. But this rule is applicable only if the asset is sold without using for any other purpose. Without using for any other purpose, this asset is sold. Then, recovery of bad debts earlier allowed as deduction, we have already seen. 3618 is not in your syllabus. It is not there in intermediate syllabus, so I'm not talking about that. Then, this last point, point number 6 is an exception to the general rule that business loss can be carried forward only for a period of 8 years. Generally, we know that business loss, if there is a loss in the current year, that can be carried forward only for 8 years. Business loss can be carried forward only for a period of 8 years, but this is an exception to that general rule. What does that say? There is a loss relating to business that occurred in, let us take, let's take the year 2012-13. 2012-13, there is a business loss of 3 lakh. 2013-14 also, there is a business loss of 8 lakh. Okay. Now what happened is, I discontinued my business. I stopped my business in 2013-14. I stopped my business in 2013-14. Okay. And after that, I did not carry any business. Business loss could not be, this 11 lakh business loss could not be adjusted against any subsequent business profit since I was not carrying a business after that. And 8 years have now expired. 8 years has expired. It's over. It can be maximum carried forward only up to 2022-23. 2013-14 plus 8 will come to 2022-23. But in 2023-24, I received 10 lakh. I received 10 lakh. And this 10 lakh is related to these deemed profits which we are explained right now. 10 lakh is related to this deemed profit we just explained now. Some bad debts earlier allowed as deduction is now recovered, or a scientific research asset for which deduction was allowed in 13-14, that is now sold. So you receive some 10 lakh. Now from this 10 lakh, we can deduct, we can set off loss relating to the year of discontinuance. Loss relating to the year of discontinuance can be set off. Loss relating to the year of discontinuance. So from this 10 lakh, we can set off 8 lakh, even if a period of 8 years has expired. So loss relating to the year of discontinuance can be set off against a subsequent deemed profit, even if a period of 8 years has expired. Loss relating to the year of discontinuance can be set off against a subsequent deemed profit received, even if a period of 8 years has expired. So that is the last point. Okay. Now, undisclosed income, black money. That is what we commonly call it as. Black money is unexplained cash credit. Cash is found credited in your books of accounts. You give no explanation. Investments found from your house. You give no explanation. Money, bullion, jewelry discovered from your house. No explanation offered. Investment bullion not fully disclosed in books of accounts. Expenditure for which there is no explanation offered. All these will be treated as black money. Okay. All these. Similarly, any loan which is borrowed or repaid otherwise than by account paid check is also treated as black money. Cash loans are treated as black money. And once the department identifies that you have black money, that will be taxable at a flat rate of 60% plus surcharge 25% plus cess 4%. That is altogether that will come to 78%. And from the black money that is discovered, there is no deduction for any expenditure, or there is no set off possible, there is no allowance possible. All black money is discovered are taxable at a flat rate of 60%. Next topic is regarding maintenance of books of accounts. Who is required to maintain books of account under section 44AA? The persons who are required to maintain books of accounts are divided into two categories: specified professionals and non-specified professionals and the business class. Okay. Specified professions are required to maintain books of accounts if their receipt from profession exceeds 1,50,000 in all the preceding three previous years. All the preceding three previous years. That is, if you are identifying whether a person has to maintain books of accounts in 23-24, go back to the earlier 3 years, 22-23, 21-22, and 20-21. In all these 3 years, your receipts shall be continuously in excess of 1,50,000 each. Each year, it is in more than 1,50,000. Then you have to maintain books of accounts from 23-24. Okay, so that is regarding specified professionals. Receipts from profession exceeds 1,15,000 in all three preceding previous years. How about non-specified professions and business? They are divided into two categories. There is one rule for individuals and HUFs and other rule for others. Individuals and HUFs, if they have to maintain books of accounts during this year, go back again to the earlier 3 years. And there are two criteria. Find out how much is profit, find out how much is receipt. Either receipt exceed 25 lakh or profit exceed 2,15,000 in any of the earlier 3 years. Okay. Either receipts exceed 25 lakh or profit exceed 2,50,000 in any of the earlier 3 years, then you have to maintain books of accounts in 23-24. If it is a company or a partnership firm, the limit gets slightly changed. Profit exceeds 1,20,000 or receipt exceed 10 lakh in any of the three preceding previous years. So these are the rule for specified professionals, and non-specified professionals, we have a separate rule. Specified professionals, the rule is that receipt exceeds 1,50,000 in all preceding three previous years. For non-specified professionals and business, individuals, we have one set of rules, and individuals and HUF, we have one set of rules, and for others, we have another set. Individuals and HUF, then we will maintain books of accounts. Either profit exceeds 2,50,000 or receipts exceed 25 lakh in any year. Okay. Others, profit exceed 1,20,000 or receipt exceed 10 lakh. Again, I'll give you an example. This month. So 22-23, which are the earlier 22-23, 21-22, and 20-21. These are the previous years. And for these three previous years, receipt, how much? Let us also see how much is his profit. How much is his profit? Receipts are 22 lakhs. These are individual. Let us assume that he is an individual. 23 lakhs and 24 lakhs. And profits are 0.3 lakh, 1.9 lakh, and 2.6 lakh. Okay. Any 1 year, any one condition satisfied. Then you have to maintain books of accounts. Any 1 year, any one condition. Receipts have not exceeded 25. So that condition is not satisfied, but this condition is satisfied. See, this condition. Any 1 year, either profit exceeds 2.5 lakh or receipt exceeds 25 lakh. Any 1 year, any one condition. So this person has to maintain books of accounts for 23, 24. So that is also over. Now we come to compulsory audit. Compulsory audit. Accounts are to be compulsorily audited. Compulsory audit, we are talking about business and professions, right? So business, if you're doing business, let me discuss this category. If you're doing business and if your turnover exceeds 1 crore, you have to get your books of accounts audited. You are doing profession and your receipts from profession exceeds 50 lakh, you have to get your accounts audited. Okay. Business turnover exceeds 1 crore. Professionals turnover exceeds 50 lakh. There is one more limit to a business. You are a person who is doing business and majority of your payment and majority of your receipt is by account paid check, which means 95% of your total receipt is by account paid check. 95% of your total payment is also by account paid check. Okay. Then you need to get your accounts audited only if your turnover crosses 10 crore. Again, I will explain. What does that say? A person whose turnover is 8 crore and his payment is 7 crore. Okay. Then account paid check payments are how much he has paid by check. Account paid check payments are, let me tell you, account paid check payments are 7.85 crore. This is turnover and payments 0.73. Okay. So this is his total turnover, of which 7.85 is in account pay. This is his total payment, of which 6.73 is in account pay. Let us calculate 95% of 8 crore. 95% of 8 crore. 8 crore into 95% comes to 7.6. Similarly, let us also calculate 95% of 7 crore. 7 into 95% comes to 6.65. See, here accounts are more than 95%. Account pay receipts are more than 95%. Account pay payments are also more than 95%. In other words, to put it in other words, only 5% of your total receipt or 5% of your total payment shall be in cash. Only 5%, maximum 5%. So minimum 95% shall be by account paid check. So in this case, this person need not get his accounts audited because his limit is 10 crore. His limit is 10 crore. So this person need not get his accounts audited. Now let me make another correction. Same question. Same example. Let me make slight correction. Here, only 7 crore is by account paid. Of 8 crore, only 7 crore is by account pay. Payment more than 95% is by account pay check. In this case, he has to get his accounts audited because his limit is only 1 crore. Okay, the limit gets extended to 10 crore only if 95% of your cash payment, 95% of your total receipts and 95% of your payments are by account pay. Let me give you another example. So in this case, it has to be audited. It has to be audited. Here, no audit. required because this is a 95%. At least this much amount shall be by account paid check, both receipt and payment. Now let me give you another example. Turnover is 12 crore. Entire 12 crore is by account paid check. Payment is 7 crore. Again, 95% of 7 crore. 6.65 has been made by account paid check. Whether those accounts are to be audited. Yes, accounts are to be audited because once the turnover crosses about 10 crore, whether you are making payment by cash or account pay, that all need not be considered. So in this case, definitely the accounts are to be audited. Definitely in this case, accounts are to be audited once the turnover crosses 10 crore. So this is regarding 2 business persons and 1 professional. Now there is one more category of persons whose accounts are to be audited. 44 AD, persons who are originally covered by 44 AD, 44 AD and 44 AE, but their limits are lower than the limits which are mentioned therein. So let us first see what is 44 AD, 44 ADA and 44 AE. What is 44 AD, 44 ADA and 44 AE, and then we'll come back. When will they be covered by audit? 44 AD, ADA and AE are presumptive profits. Presumptive profits meaning the objective of this section is to make compliance easier for persons who are having a small turnover so that their tax compliance becomes easier. So the persons who are having only very small turnover, we'll see what is the turnover limit and all. Persons who have only, having only very small turnover, that is, it's more than 1 crore, more than the limit which is subject to audit, but not that much. Even then, it's not that much. If your turnover is above, the turnover does not exceed 1 crore and all. Turnover does not exceed 1 crore and all. You don't have that much huge turnover. In that case, if you want to get your accounts audited and all, like if you have to maintain books of accounts, you will have to appoint a staff for carrying out all this work. There should be a tally which has to be installed in your system. This will make all the administrative expense, it will become costly. So to cover all these, the income tax department says that we make an assumption that this much is your profit. We make an assumption. You need not maintain books of accounts. You need not maintain, you need not get your accounts audited. Just accept the profit which we are advising, which we have presumed. We assume, the department says, we presume this much is your profit. If you are ready to pay taxes upon that profit, then books of accounts are required, audit is not required. Let us see who are the persons that are covered by this section. 44 AD is applicable to resident individual, resident HUF, and a resident partnership firm. But this is not applicable to a person who is engaged in agency business, commission or brokerage, claiming deduction under 10A or 80IA to 80RRB. If you're claiming some other benefits, then you cannot claim deduction under this section. You cannot claim the benefit of this section, rather. You cannot claim the benefit of this section. So if you're doing agency business, if you're earning commission or brokerage, or you are claiming deduction under 10A or 80IA to RRB, you are not covered by section 44 AAD. Now, when will this special rule will be applicable to you? Your turnover is less than 2 crore. But of course, 5% is only in cash. Then persons having turnover up to 3 crore will be covered by this rule. Persons having turnover up to 3 crore. This 3 crore limit has been introduced from assessment year 24-25. So 2 crore normally. But if your turnover, most of the turnover is by account paid check, then only 3 crore persons having a turnover up to 3 crore can get the benefit of this section. What is your presumptive profit? The department presumes that your profit is 8% of turnover. Like if your turnover is 2 crore, I assume that your profit is 2 crore into 8%, that is around 16 lakhs. 2 crore into 8%, that is around 16 lakhs. But if majority of your payment, if the payment is received by account paid check, out of 2 crore, let us take 1.2 crore is received in account paid check, then the percentage is not 8%, it is 6%. It is 6%. 1.2 into 1.2 crore into 6% plus 0.8 crore into 8%. Okay. If the receipts are by account pay, check or draft or ACS, then the percentage is not 8, it is 6%. So this is a presumptive profit. So assume that your turnover is 2 crore and the entire amount is collected in cash. I assume that your profit is 2 crore into 8%, which is equal to 16 lakhs. 2 crore into 18%, which is equal to 16 lakh. Can you claim any other deduction from that 16 lakh? No deduction under this head. There is no deduction under the head business can be claimed. All deductions under business are presumed to have been allowed. All disallowances are deemed to have been added back. All disallowances are deemed to have been added back. Then advance tax liability, the person need to pay advance tax only by March 15, need not pay advance tax in 4 installments. Once you choose the scheme, you have to continue in the scheme for 6 consecutive years. If you exit from the scheme within 6 years, then you cannot re-enter into the scheme for a period of 5 years. Okay. So if you go out of the scheme within 6 years, if you opt out of this presumptive scheme, you choose audit. For the next 5 years also, you have to keep on getting your accounts audited. Then you cannot choose 44AD. So that is regarding 44AD. Okay, 44AD, that is applicable to resident individual, resident HUF, and your presumptive profit is assumed to be 8%, but if it is calculated by account paycheck, it is only 6%. 44ADA. 44ADA is applicable to a persons who are engaged in professions like doctors, chartered accountants, engineers, lawyers. They are covered by 44AA. They are the persons who are listed under 44AA, and thus those persons can take the benefit of 44ADA. Turnover is 50 lakhs. Only for a person whose turnover is 50 or less than 50, they can go for this section. 75 lakhs is the limit. A person having turnover from profession up to 75 lakh. Usually you don't use the term turnover in profession, you use the term receipt in profession. A person having a gross receipt up to 75 lakh can go for this presumptive taxation if all their cash receipt is only up to 5%. And what is the presumptive profit? Presumptive profit is 50% of your turnover, 50% of your receipt. If the turnover or receipt from profession is 40 lakh, department assumes that your profit is 20 lakhs. If your turnover is 45 lakh, department assumes that your profit is 22.5. Any other further deduction allowed under the head business? No. No deductions, no disallowances. Advance tax to be paid by March 15. There is no such case that once you choose this section, you have to continue in this section for a period of 5 years and all. You can make different decisions in different financial years. Last section is regarding 44AE. 44AE. 44AE is applicable to a person who is engaged in the business of hiring, leasing, or plying goods carriage. Okay, those persons who are engaged in goods carriage, they can go for this rule. Now, the turnover, the limit is not fixed in terms of turnover. Instead, a person who is having only maximum 10 vehicles, maximum 10 vehicles at any time during this year, they can choose 44AE. But that person should own only maximum 10 vehicles. Then what is the rule which we assume here? You have made a profit of 7,500 per month per vehicle for light and medium. For light and medium. Light and medium vehicle means a vehicle whose weight is weight of the vehicle is equal to or less than 12,000 kilo. Such vehicles are called as light and medium vehicle. Light and medium vehicle, you have made a profit of 7,500 per month per vehicle. If it is a heavy vehicle means weight is more than 12,000, then the profit is assumed to be 1,000 per ton per month. Per ton per month. If the vehicle weight exceeds 12,000, the profit also varies depending upon the weight of the vehicle. And ton means 1 ton means 1,000 kilo. So assume that it is a vehicle having a weight of 15,000 kilo. 15,000 kilo means 15,000 ton. For 1 ton, 1,000 profit. So 15 ton total profit is 15,000. That is the profit which you have made per vehicle per month. Multiply by the number of months and all. Month here includes part of the month. Month here includes part of the month. And another important point, here taxes are to be paid or profit is assumed for the month for which you are the owner of the vehicle. Ownership is important here. Even if the vehicle is not put to any use, you have to pay taxes. We assume that you have made a profit of 7,500. Like, let me clarify. A vehicle was purchased in June. It was used only from August. June and July, it was not put to any use. But even then, profit is considered for June and July. We have to pay taxes for June and July. The stress we keep here in this section is upon usage, it is upon ownership, and it's not usage. Depreciation, we look into usage. Depreciation, if you want to claim deduction, it is usage. But here, presumptive taxation, we consider only ownership. If you are owner, pay taxes. Pay taxes under the presumptive scheme. So that is 44AE. So what is a further deduction which can be allowed? Remuneration and interest to partners is allowed as deduction. Advance tax liability, that must be paid in all 4 installments. The connection between compulsory audit and these sections. What is the connection between compulsory audit and these sections? Say a person who is carrying specified profession, 44 ADA, let us take a person, a chartered accountant. A chartered accountant having an income of only 40 lakhs. Having an income of 40 lakhs. So the department presumes that he has made a profit of 20 lakh, 50%. Is it not? 50%, 20 lakh. But the chartered accountant says that, no, my profit for the year is only 8 lakh. It's not 20. It's not enough that you say that. It has to be proven. And how do we prove? Get it audited. So if you are not paying taxes as per the, if you are not paying or if you don't disclose profits as per presumptive tax, then also will be covered by compulsory audit. A person whose turnover is less than 50 lakh will also be covered by compulsory audit if he is not ready to pay taxes on 20 lakh profit. That is 50% profit. A person whose turnover is less than 50 lakh, a professional whose turnover is less than 50 lakh will be covered by compulsory audit if he is not ready to pay taxes on 50% profits. Okay, so that is when all these persons will get covered under compulsory audit. You are not ready to pay taxes on that minimum, which is assumed in the section. That is over. Now let us come to 2 more sections are remaining here. 2 other sections. One is 43A. What is 43A? And what is 43CA? 2 more sections remaining. 43A and 43CA. (43A), this says that an asset has been acquired from outside India. Okay, an asset has been acquired from outside India, and there has been an increase or decrease in liability. You're making payment in foreign currency since asset is made purchased from outside India. So there's an increase and decrease in tax liability on account of fluctuation in foreign exchange rate. Such increase or decrease is to be adjusted in the cost of asset in the year of making payment, even if we are following mercantile system of accounting. Increase or decrease is to be adjusted in the cost of asset in the year of making payment, irrespective of method of accounting. I'll give you an example. I purchased an asset on credit. Okay, on credit in March 2024. The asset was purchased for $5,000. In March 24, the rate of foreign currency was 5,000 into, let us take 80 rupees. That is 5,000 into 8, 40 lakhs. Or is it 4 lakh? Yes, 4 lakh. So I recorded a journal entry, asset account debtor to supplier. Asset account debtor to supplier, 4 lakh. This is a journal entry which is recorded in March 24. As I told you, this is purchased in credit, purchased on credit, and he had given me some 6 months time to make the payment. 6 months time to make the payment. So I recorded this journal entry, asset account debted to supplier, 4 lakh, 5,000 into 80 rupees. And the payment was due in September 24. So September 24, I'm making payment to the supplier. My entry will be supplier account debtor, 4 lakh to bank. When I went to bank, the banker said that there has been increase in foreign currency rate. Now the foreign currency rate is 90 rupee. So if you want to remit 5,000 US dollar abroad, you have to give me 4,50,000. Only then you can remit 5,000 there. So I have to make an extra payment of 50,000 rupees. Is it not? I have to make an extra payment of 50,000 rupees. My question is, what should be debited here? Whether it should be debited to P&L account as foreign currency fluctuation, or is it to be debited to asset account? Whether this has to be charged to revenue or whether this has to be capitalized. That extra 50,000, whether it has to be added to cost of asset in September 24, or whether it is charged in the P&L account as foreign currency fluctuation loss in P&L account. Let us see what does the section say. The section says that increase or decrease is to be adjusted in the cost of asset in the year of making payment. In the year of making payment, irrespective of the method of accounting. Even if you're following mercantile system, this rule is applicable. So 50,000 will be debited to, what is the rule? 50,000 will be debited to asset account. So this is a correct treatment which is to be done. That is what section 43A says. Okay. Now let us see what is 43CA. 43CA, this rule we are going to discuss in capital gains. We are also seeing this rule in gift, other sources. The same sections, it has been copied and pasted in capital gain as well as in other sources. Let us see what does this section say. I'm a real estate developer. Okay, so I'm building and constructing flats and I'm selling land and building to my customers. You know, when we have to register this land and building, the government has fixed something called as fair value in different areas. Fair value, or here what we use is stamp duty value. Common man uses the term as fair value, but here stamp duty value is the term which they have used. So the government has fixed stamp duty value in various areas. When you sell the property, you have to disclose the sale consideration as minimum stamp duty value. In other words, the stamp duty value in this area is 20 lakh. You are saying that your sale consideration, you are selling this property for 15 lakhs. Even if you are selling this property only for 15 lakh, for the purpose of computing taxable business income, I will take sale consideration at 20 lakhs. Minimum stamp duty value has to be your sale consideration, minimum. That is what the department says. You cannot sell a property at a value less than stamp duty value. You have to show the consideration at minimum 20 lakhs. You have to pay stamp duty on 20 lakh, not on 15 lakhs. Government requires a minimum revenue. For that purpose, they have included this rule. So they have fixed stamp duty value in various areas. You have to sell your properties minimum at that rate. On the other hand, if stamp duty value is 20 lakhs and you have sold your property at 25 lakh, then your sale consideration will be 25 lakhs. Okay, so minimum sale consideration shall be your stamp duty value. All right. Now, next point. Construction of real estate property. How a transaction of real estate property normally happens is, we will first of all enter into an agreement. We'll pay some advance, and then the registration happens where we'll be paying the balance payment. So you were selling a flat. The agreement for this flat sale was entered in. Agreement for the flat sale was entered in September 2021. and the registration happened. It took around 2 to 3 years, July 24. On the date of agreement, the stamp duty value was 20 lakhs. And when we went for registering the property, the stamp duty value had been increased to 22 lakhs. Okay. At the time of agreement, the stamp duty value was only 20 lakhs. But when we registered the property, it is now 22 lakhs. Now, which shall be taken? 20 lakhs or 22 lakhs? Which shall be taken in this case? In this case, it is permitted, you can take 20 lakhs. Always stamp duty value only increases. There is only a upward revision. Very rare there is a downward revision because land value always increases. That is what we assume. Land always appreciates. So as we move on further, the values will only keep on increasing. So agreement happens first, registration happens later. So you may take 20 lakhs. Stamp duty value of 20 lakhs can be taken if there is a difference, subject to two conditions. Subject to two conditions. Condition number one is you have to pay an advance on the date of agreement. You have to pay an advance on the date of agreement. And that advance has to be paid by account paid check. That advance has to be paid by, of course, account paid check or draft or PCS. These are the two conditions if we have to take that lower stamp duty value, 20 lakh. As on the date of agreement, pay advance, portion of the sale consideration. Advance means that a portion of the sale consideration has to be paid as advance on the date of agreement, and that advance has to be paid by account paid check or draft or ECS. Only these two conditions are satisfied. Only these two conditions are satisfied. You can take 20 lakhs. You can fix the stamp duty value as 20 lakh. Otherwise, we'll have to take 22 lakhs stamp duty value. Okay. So let us read 43 CA. If the sale consideration of land or building or both is lower than stamp duty value will be taken as sale consideration. If there is difference between stamp duty value on the date of agreement and on the date of registration, stamp duty value on the date of agreement shall be taken subject to two conditions. Advance has been paid and it has been paid by account paid check or draft or any other mode. Okay, there is another rule, one more rule. If there is only small difference between stamp duty value, if there is only small difference, you may just ignore stamp duty value. Ignore stamp duty value. If there is only small difference. And what is that small difference given as? 10%. If the difference between stamp duty value and sale consideration exceeds 10%, you take stamp duty value. If that doesn't exceed stamp duty value, no problem. You can take the actual consideration. Okay, let us see what does that mean. Let us see what does that mean. If there is only small difference, ignore the section. Ignore 43 CA. Stamp duty value is 20 lakh. Actual sale consideration is 19 lakhs. Okay. So let us add a 10% with 19 lakh. 19 lakhs plus 10%. 19 lakh plus 10% is equal to 19 lakh plus 1.9 lakh, which is equal to 20.9 lakh. If the stamp duty value is less than or equal to 20.9, stamp duty need not be considered. Stamp duty need not be considered. A 10% margin is always permitted. 10% margin is always permitted. Only if stamp duty value is more than 10%, you may take stamp duty value. So in this case, stamp duty value does not exceed 20 lakh. Stamp duty value does not exceed 20.9 lakh. Stamp duty value does not exceed 20.9 lakh. It is within that 10% margin. Just ignore stamp duty value. Here you may take your sale consideration at 19 lakh itself. Okay. Then during the corona period, I think this is the corona period. If there is any transfer that has happened, in order to increase the sales that are happening, what we provided is any variation up to 20% is also permitted. That is, you may sell your property at a value of 80% of stamp duty value. Even then, there is no problem. During the corona period, we had permitted a variation up to 20%. So what is that? It's 20%. That 20% rule is not applicable between 23-24. It is applicable only for 20 and 21. Let us see the exact date. It's the residential unit that is transferred. Transferred between 12, 11, 20, and 21. Transfers by way of first time allotment. That is, builder is allotting it. And the consideration does not exceed 2 crore. If all 3 conditions are satisfied, a variation up to 20% is permitted. All these conditions are satisfied. So normally, variation of only 10% is permitted. Now we can permit up to 20%. These are the various provisions of we have completed all theory portions of business. Now let us do some problems. Again, before going to that, let us see 115 BAC as well. Let us see 115 BAC. Okay. 115 BAC. What is the difference for or any other deductions which are not permitted if you are going for 115 BAC? When we are going for 115 BAC for salary, we have seen that certain deductions are not permissible, exemptions are not permissible. 15 days for a business. A business person, if he is choosing 115 BAC, these are the 4 items which he cannot claim as deduction. These are the 4 items. 1, if you are choosing 115 BAC, there is no additional depreciation that is possible. If you are choosing 115 BAC, we cannot claim additional depreciation. All right. If you are choosing 115 BAC, you cannot claim 100% deduction for scientific research. You cannot claim deduction for specified business. 3580 deduction is not permissible. 35CCC is not in our syllabus, so we won't look into that. Okay, so if a person is in business and is choosing 115 BAC, he cannot claim additional depreciation, he cannot claim 3580, he cannot claim the section 35 deduction. Also, house property, if you are choosing 115 BAC, what is the difference? House property, if you are choosing 115 BAC, what is the difference? Remember yesterday when we discussed house property, we had given that if it is a self-occupied property, there is no deduction for, there is no income that is to be taxed. GAV is nil, there is no deduction for municipal tax, net and value 0, standard deduction 0. But we can claim a deduction for interest on loan for a self-occupied property up to 2 lakhs. But if you are choosing 115 BAC, even that 2 lakh cannot be claimed. 115 BAC, self-occupied property, there is no deduction for interest. Let-out property, no problem, you can claim deduction for interest. But 115 BAC you are choosing, you have a self-occupied property, there is no deduction for interest. There is no deduction for interest. So self-occupied property income will be always 0 if you are choosing 115 BAC. Even if there is interest. Even if there is interest, your income will be always 0. And business, I told you there are 3 deductions not possible. Additional depreciation, section 35 scientific research and 3580 specified business. So let us do this question. The question from November 23 suggested answer. November 23 suggested answer. Mr. Pramod is a resident aged 55 years. He is a retail trader. He furnished the following information for assessment year 24-25. He has got a P&L account. Opening stock is given. Purchases is given. Transportation charges, gross profit, sales and closing stock. This is the P&L portion. Very small P&L account. Salaries, rent and taxes, then administrative expenses, depreciation and net profit. On the credit side, there is gross profit, rent from house property, rent from furniture. All the sales are by account paying check. Opening and closing stock have been overvalued. Rates and taxes include GST liability, which is paid on 1/5, and municipal taxes of let out property. So there are certain adjustments regarding rates and taxes. Administrative expense include 25,000 paid as donation to National Children's Fund, and payment for laptop, which is purchased on 15/5/23 through bank transfer. So the laptop which is purchased has been included in administrative expense. Transportation charges 30,000 paid in cash on 1/9/23. He incurred a loss of rupees 8,000 on sale of equity shares on 10th February 24, which were purchased on 10/6/23. So there is a short-term capital loss. Depreciation includes 1,200 as depreciation on trademarks, which was wrongly charged at 15%. Trademark is an intangible asset. So actual depreciation is 25%, but there is only 15% depreciation charged. He deposited 50,000 to PPF and has paid a life insurance premium of 60,000. He paid interest of 70,000 on loan availed for higher education of his wife. Compute total income and income tax payable if business profit is computed as per normal provisions and he opts for 115 BAC. Okay, he takes 115 BAC. Then it is computed under presumptive taxation under 4480 and he does not opt for 115 BAC. Business profit is computed as per normal provisions and he does not opt for 115 BAC. So first, no 115 BAC, then 115 BAC, and then presumptive taxation. So there are 3 calculations to be required, and you also have to choose what is advantageous for Mr. Kumar. Okay. So first I am calculating as per normal provisions. Okay. Normal provisions. There are 3 steps which we have to do. Normal provisions. Normal provisions and opts out of 115 BAC. Let me do that first. Opts out of 115 BAC. Opts out. Opts out of 115 BAC. See, whenever you are doing these problems, what is required, you have to leave a page first. Leave a page first. First page will be for computation of total income. Computation of total income for assessment year 2024-25. This is how you mention brackets previous year 2023-24. Okay. Also mention his name. What is his name? Mr. Pramod. Mr. Pramod. Okay. We are computing total income as per 115 B. He has opted out of 115 BSc first. Then I think he has 3 incomes there. One is business income, then there is house property income and rent from furniture, which we can charge only under the head other sources. It's not relating to building. So I will charge it under other sources. Okay, so there are 3 incomes. One is income from house property. We have to mention all these in working note. Then there is profits and gains of business and profession. Profits and gains of business and profession. There is income from other sources. Always try to answer what is asked in the question. Okay, so all these 3 added together, we get gross total income. Less deductions under Chapter 6A. Deductions under Chapter 6A. I think there is 80C there, then 80E, I believe. Anyway, leave some space for all that. I'm not sure. And the balance which we get now is the taxable income. So this is the first step. Leave a space for all these. Leave a space. This is your final answer. Taxable income. Upon this, we have to pay tax. So that is our next heading, computation of tax liability. Computation of tax liability. Again, leave a space there. Again, leave a space. Now we'll come to working notes. Okay, now we come to working notes. And whenever an answer is obtained from working note, you have to give here reference. Refer working note number 1. If there are so many working notes, give number. So let us first calculate working note number 1, computation of profits and gains of business or profession. Any short forms in your answer? This is how you should proceed. Okay. Your first question, compulsory question, as it is till November 23. It is first, there will be a compulsory question on computation of total income and tax liability. So leave a page for computation of total income and tax liability. Then we'll start with the working notes. So first we are calculating PGBP. Okay, since this question mainly revolves around PGBP, you first calculate PGBP. And PGBP, when you compute, you always have to start with net profit as per P and L account. All right, net profit as per P and L account. That is what we start with. Net profit as per P and L account is given at 10,46,000. Okay. Then the next adjustment, we have to look into each and every item of the P and L account and see whether that is permissible. That is permissible. See, how do we proceed is like, if there is any item which is debited in P and L account, like salary, it is debited in P and L account. If it is not allowed as deduction under Income Tax Act, for some reason, if the salary cannot be allowed as deduction under Income Tax Act, the salary has to be removed from here. If salary is removed from here, what happens? Profit increases. So what we call for that is add back. Add back. Add back those items which are debited in P and L account. Add back those items which are debited in P and L account but not allowed as deduction under Income Tax Act. Not allowed as deduction under Income Tax Act. Okay. Add back. Inadmissible expense. That is what we call that. Adding back. So we'll now see each and every item in the P&L account, and simultaneously we will also see if there are any related adjustments. If there are any related adjustments, and we'll do that adjustments also together. So the first item is opening stock. See, there is any adjustment regarding opening stock. Yes, the opening stock have been overvalued. So also the closing stock. Opening stock and closing stock have been overvalued by 15,000 and 20,000 respectively. So we'll do this adjustment first. Since we have seen opening stock, we'll take that adjustment first. Opening stock is 1,15,000, but this is wrong. This is not the correct value of opening stock. Opening stock, the value is higher by 15,000, 1,500. Expense is on a higher side. We have to deduct the value of opening stock. Opening stock has to be made to 1 lakh because your 15,000 is overvalued. You have kept it is overrated. So the value of opening stock should be only 1 lakh. In other words, we have to reduce the value of opening stock. What happens if expense value is reduced? See, opening stock purchases, all these come under the expense side, is it not? All these come under the expense side. So we have to reduce the value of expense. If expense is reduced, what happens to profit? Profit increases. So you need not correct the trading and P&L account, and you need not make a fresh trading and P&L account. Instead, all adjustments will be made to this profit. We'll correct this profit. We are not correcting the P&L account. Okay, we will correct this profit. So this profit does not reflect a true value because opening stock figure is not correct. Opening stock has to be reduced. Opening stock is on expense side. If expense is reduced, profit is increased. So add overvaluation of opening stock. Overvaluation of opening stock. Usually what we do is all items that are to be added will be first listed, and then we will go to the items which are to be deducted. Okay. Now, what happens to closing stock? We are doing this both these adjustments together. Closing stock is also overvalued. This 2,10,000 is not the correct figure. It is on a higher side. 2,10,000 is on a higher side. We have to reduce value of closing stock. Closing stock is on income side. If we reduce the value of closing stock, income is reduced. Profit also gets reduced. Profit also gets reduced. So less overvaluation of closing stock. Overvaluation of closing stock is 20,000. Okay, so we have discussed opening stock and also we have discussed closing stock. Purchases. I think there are no adjustments regarding purchases. No. There are no adjustments regarding purchases. Transportation charges. There is one adjustment. Point number 4. Transportation charges. Point number 4. Transportation charges include 30,000 that is paid in cash. No adjustment is required regarding this 30,000 which is paid in cash because normally we know that where an expenditure in excess of 10,000 is paid in cash, it is not allowed as deduction. Where any expense in excess of 10,000 is paid in cash, it is not allowed as deduction. But for transporter, we can make a payment up to 35,000 in cash. So no disallowance is required regarding this transportation charges, but you have to mention a note. You have to mention by way of a note why this is not disallowed. Let us give a note to that effect. No disallowance. Under section maximum possible, mention all the sections. Under 48(3), for cash expenditure of 30,000, rupees 30,000 on transportation charges. The limit for disallowance for transportation is 35,000. So you have to mention all these things, okay? Why an item was disallowed or why an item was added, all these are to be mentioned. So we need not look into transportation charges, that is over. Gross profit, no further adjustment required. Sales and closing stock, no adjustment required. Now let us come to the P&L portion. Salaries. Salary, no adjustment. No adjustment. Rates and taxes, yes. Rates and taxes. What is adjustment for rates and tax? Rates and tax include a GST liability of 5,000 paid on 1/5/24. See, that is an adjustment. There was a liability of 5,000 included in this amount. There was a liability of 5,000 that was included in this amount. That was not paid as on 31st March, but it has been paid on 1st May. That is, GST liability has been paid before the due date of filing return of income. It has been paid before the due date of filing return of income. Is it not? Before 31st July. It was not paid on 31st March. No problem. It has been paid before 31st July. So it is fully allowed as deduction. So no disallowance is required. On the other hand, if the date here had been, instead of May, if the date here had been December 24, instead of 1st May, if the date had been 1st December, the payment is made only after due date. So the deduction will be allowed only in the next year. This year we will have to add back. But since it is paid on 1st May, no disallowance is required. So again, we have to give a note to that effect. No disallowance in respect of, no disallowance under section, also mention the section, under section 43B, in respect of GST liability 5,000 Why? What is the reason? It is paid before the due date of filing return. As it is paid before the due date of filing return of income. Okay. So there also, there is no adjustment required. How about the second part of this point? Point number 2, second part. Municipal taxes of let out property is 7,000. Municipal taxes of let out property, 7,000 is included in this rates of taxes. See, there is a rent from house property of 1,80,000. You are receiving rent from house property, 1,80,000. In respect of that house property, we are paying municipal taxes. 1,80,000 is not business income. It is to be charged under house property. So the expense relating to the house property also cannot be debited in P&L account. It has to be debited, it has to be deducted from 1,80,000. So 1,80,000 we are taking to house property. 7,000 also we'll have to take to house property. So this 7,000 cannot be debited in P&L account, which means we have to remove that. If you remove that 7,000 from this P&L account, your profit will increase. So add inadmissible expense. Add inadmissible expense of that one expense related to house property debited in P&L account. Expense related to house property debited in P&L account. How much is that? 7,000. If you want, we may specifically mention what is that. What is the expense related to house property? Municipal tax. Municipal tax. So that is not to be debited in P&L. That has to be removed. So that adjustment is done. Next is administrative expense 3,25,000. Administrative expense 3,25,000. There is an adjustment number 3. Adjustment number 3. Administrative expense include 25,000 paid as donation to National Children's Fund. Donation is not a business expenditure, except donation for scientific research can be allowed as business expenditure. Okay, donation for scientific research can be allowed as business expenditure, but donation to a National Children's Fund, you can claim it as business expenditure, but instead we'll claim deduction under 80G. Okay, there is another section called 80G. We'll be discussing later, chapter 6A deduction 80G. So this 25,000 is deducted from gross total income. It's not deducted from business. It cannot be deducted from business profit. So 25,000 has to be added back. Donation 25,000 debited in P&L account. Donation to National Children's Fund debited in P&L account. 25,000. What is further adjustment which is required? One more item in that. Administrative expense, there is one more item. Laptop purchased on 15/5/23 through bank transfer. There is a laptop which is purchased, and laptop purchased is debited in P&L account. No, you cannot do that. Capital expenditure cannot be debited in P&L account. So we have to add back 60,000 capital expenditure, but we can immediately claim depreciation on laptop. Is it not? Depreciation on laptop will not be included in 80,000. So we have to add back 60,000 and we can claim depreciation on laptop. So 3, capital expenditure. What is it? Capital expenditure? Laptop debited in P&L account. 60,000. But immediately I can claim less admissible expense. Less admissible expense. What I can claim? Depreciation on laptop. Depreciation on laptop. Depreciation is 60,000 into 40%, which is equal to 24,000. Okay, that can be claimed immediately. So that is also over. This is regarding capital loss. That doesn't relate to business. So no adjustment. Then depreciation 80,000, there is an adjustment. Depreciation includes 1,200 as depreciation on trademarks that was wrongly charged at 15%. Wrongly charged at 15%. Meaning we have to claim an additional 10% also. 25% is the depreciation on trademarks, that being an intangible asset. Depreciation rate is 25%. So we have to claim an additional 10%. Now, how much do we calculate 10%? 15% is equal to 1,200. 15% is equal to 1,200. So what is 10%? 1,200 divided by 15 into 10. 800 rupees depreciation is also to be claimed. Extra depreciation of 10% on trademarks. Extra depreciation of 10% on trademarks. Okay, we have to claim another 10%. So we are calculating how much is that 10%. If 15% is equal to 1,200, how much is 10%? That again can be deducted. So that is calculated. This is 80C. This is 80E. We have 80G also here. Chapter 6A, we have 80G also. That is National Children's Fund. Then let us come to the credit side of P&L account. There is rent from house property. This is not business income. This shall not be here, which means if you remove this 1,80,000 from here, profit decreases. So we have to deduct house property. We have to deduct rent from furniture. House property, we have to charge as under house property income, and furniture and we have to charge under other sources. So again, from business, we have to deduct two items. Less house property income credited in P&L account. House property income credited in P&L account. 1,80,000. Similarly, another item to be deducted is IFOS income. Income from other sources credited in P&L account. If you want, you may mention that it is rent for furniture. Rent for furniture is also to be deducted. 1,20,000. So P&L account taken, all the adjustments for the time being are taken. Now let us see how much is business income. How much is business? And all those items. Also deduct these items. At 44,800. So this is finally profits and gains of business or profession. Profits and gains of business or profession. $8,08,200. Let's take this to business. Profits and gains of business or profession is 8,08,200. Okay. So we have completed business income. Now let us see how much is house property income. For house property, we have to start the next working note. Working note number 2. Computation of income from house property. Computation of income from house property. Okay. Since details of RER are not given, details of RER, actual rent are all not, details of RER is not given, we take actual rent as GAV, that is 1,80,000. You also have to mention that as RER details are not given, details of municipal value, fair and standard rent, all that are not given. We are taking actual rent as GAV. So 1,80,000 is GAV, less municipal taxes. There was a municipal tax that was debited in P&L account, 7,000. Net annual value, 1,73,000. Standard deduction, less deduction under section 24. Deduction under section 24, standard deduction, 30%. Interest details are not given in the question. Interest details are not given in the question, that is 0. 51,900. So this is finally income from house property. Lakh 21,100. 1,21,100. Let us take to the main answer. Okay, that is also over. Income from house property is 1,21,100. Profits and gains of business and profession is 8,08,200. Now what else? Yes, we have a short-term capital loss. He incurred a loss of 8,000 on sale of equity shares on 10/2/24, which was purchased on 10/6/23. There is a short-term capital loss, but short-term capital loss cannot be set off against house property or any other income, can only be carried forward. So anyway, but we have to mention that in this answer. Short-term capital loss. Short-term capital loss. Short-term capital loss is 8,000, but this cannot be set off. This will be carried forward. To be carried forward to assessment year 2025-26. This is carried forward because capital loss can be set off only against capital income. Capital loss can be set off only against capital income. So this is carried forward, 8,000. So that is 0. Then we have income from other sources. That is that furniture income. Furniture income is 1,20,000. Furniture income is 1,20,000. So all added together, we get the gross total income. $10,43,000. Then there are the deductions, ATC, ATG, ATE, other deductions. ATC, there are 2 items for which we can claim deduction, that is PPF and LIC. Both qualify for deduction under ATC, both PPF and LIC. PPF and LIC is 50,000 plus 60,000. 50,000 plus 60,000, that comes to 1,10,000. Then ATG is that National Children's Fund, donation 25,000. When you write these, you have to also mention what is this deduction for. This deduction is for donation to National Children's Fund. You have to mention that. Donation to National Children's Fund. Mention all those things. Then AT is for interest on educational loan. Interest on educational loan. How much is interest on educational loan? He paid interest of 70,000 on loan availed in financial year 17-18. Yes, 70,000. These are his total deductions. After deducting this, his net income will be 10,49,300 minus 2,05,000, 8,44,300. This is his taxable income. Now it's not over. You have just calculated the taxable income. What we have to calculate next is tax liability, computation of tax liability. How much is tax liability? This is as per the old regime. So up to 2,50,000 it is nil. 2,50,000 to 5,00,000. How much is his age? When you compute tax liability, look into his age. 55 years. So 2,50,000, 12,500, 5 to 10 lakh, 5 to 10 lakh, it is 3,44,300 into 20%. Add 4% cess. 4% cess. Eighty-four 614 rounded off under section 288B2. Both income and taxes. Both income and taxes are to be rounded off. Income is both rounded off to the nearest multiple of 10. Okay, both rounded off to the nearest multiple of 10. So this is your final answer. Income is rounded off under section 288A. Income is rounded off under section 288A and taxes are rounded off under section 288B. Taxes are rounded off under section 288B. So what we have now calculated is this topic. He does not opt for 115 BAC and he is paying tax under normal provisions. And this is the amount which we have calculated now. Okay. Now, what if he is paying taxes under normal provisions? It's not presumptive taxation, and he opts for 115 BAC. He opts for 115 BAC. Let us see what are the changes. If we opt for 115 BAC. See, house property, there are no changes. House property, there are no changes. So let me do it here. For examination, you have to do it in a separate table. Here, let me just make a comparison. 115 BAC, what will be the changes? 115 BAC. House property. House property, if you're in 115 BAC, the only problem was that house property, if you are in 115 BAC, the only problem was that if you choose 115 BAC, you cannot claim interest for self-occupied property. You don't have a self-occupied property here. It's a lettered property, so you can claim interest. There is no change. It is 1,21,100 itself. Profits and gains of business and profession, there is no deduction for additional depreciation, scientific research, and specified business. But I think there is no such items here. There is no additional depreciation. There is no scientific research. There is no specified business activity. So here also there is no change. 8,08,200. Capital loss we are not considering anyway. It is 1,20,000. So total income will be the same. 10,49,300. When you are choosing 115 BAC, you cannot claim deductions under Chapter 6A. See, 80C to 80U are not allowed. 80C to 80U. Two sections are allowed. One is 80 CCD2, 80 JJAA, but we are not claiming here CCD2 and JJAA, which means no deduction. Deduction under Chapter 6A. So your taxable income will also be 10,49,300. So in 115 BAC, if you are going, your net income will be 10,49,300. This will be your net income. Okay. Now let us compute tax as per the new slab. What is 115 BAC slab? Up to 3 lakh mil, 3 to 6 lakh, 6 to 9 lakh, 9 to 12 lakh. This is a slab. So let us calculate. To 3 lakh 0, 3 lakh to 6 lakh. It is 15,000, 5%. 6 lakh to 9 lakh. It is 10%, so 30,000. 9 lakh to 12. You don't have the entire income. Above 9 lakh income is 1 lakh 49,300. That into 1 lakh 49,300 into it is 5, 10 and 15%. 22,395. Total comes to 67,395. Add 4% cess. $70,091. Again, that will be rounded off to 17,090. So when you round off, what you have to look into is if the last digit is 1, 2, 3, and 4. If the last digit is 1, 2, 3, and 4, you have to round down. You have to round down to the lower 10 multiple of 10. If it is 5, 6, 7, 8, and 9, you have to round up. Next 10. Okay. So 17,091 will be rounded off to 17,090. That is the answer. 17,091 is rounded off to 17,090. Earlier, 84,610. That is also, we have got that 84,610. So these are the two options. Now we have one more options. Let us see the question once again. Let us see the question once again. We have computed as per 115 BAC. Now the next option is you are opting to compute business under presumptive taxation under 44 AD and he does not opt for 115 BAC. So tax slabs are the higher one, but it is presumptive taxation. Presumptive taxation means your turnover into 6%, 70 lakh 80,000. See, all sales are by account paid check. All sales are by account paid check. So your business income is 70 lakh 80,000 into 6%. No further adjustments required in business. No further adjustments required in business. House property and other sources won't change, but business income is 70 lakh 80,000 into 6%. So let us again do that in a table format. So this was 115 BAC. Now we are going for 44 AD. 44 AD, presumptive taxation. House property, no change, 1,21,100. Business income is turnover into 6%, 70 lakh 80,000 into 6%. Why 6%? All the receipts have been by account paid check or through bank transfers. So 70 lakh 80,000 into 6%. No change for house property. Total income is 6 lakh 65. You can claim deductions 2 lakh 5,000. You are not chosen for 115 BAC, right? 44 AD and does not opt for 115 BAC. So final taxable income is 4 lakh 6,900. We'll find out tax. For 4 lakh 6,900, what is the tax? 4 lakh 6,900 up to 2 lakh 50, there is no tax. Up to 2 lakh 50, there is no tax. Above 4 lakh 60, it is about 2 lakh 50. 4 lakh 6,900 minus 2 lakh 50. That into 5%. $10,545. But you know, his income is less than so there is rebate less than 5 lakh. So rebate 10,545. Tax payable is 0. There is no tax payable. Tax liability is 0. Tax liability is 0. So here 70,090, here 84,16. Let me keep it in bold. Let me keep in bold all tax liabilities. The first option 115 out of 115 BAC, then it is 84,610. In 115 BAC, it is 70,090, and if you are under 44 AD, it is 0. So which is better? Definitely, he may go for presumptive taxation. That is a better option. I think they would have given a comment to that effect. It is beneficial for Pramod to opt for presumptive taxation and not to opt for 115 BAC. The third option is better. That has the least tax liability. Okay. Everything is covered, almost every provision is covered in that section. 115 BAC, then all those were covered there. Let us find one more question. I think we can do one more question. One MCQ. Yes. This is an MCQ question from RTP May 23. Since this question is different, slightly different from the normal, we will do this question also. RTP May 23. Usually, when we calculate depreciation on our actual cost. On our actual cost. The amount which I have paid, that will be taken as my cost of acquisition. That is the usual way. But section 43(1) says that in certain cases, the actual cost will not be taken as our cost of acquisition. Any amount other than actual cost is taken as our cost of acquisition. Any amount other than actual cost in certain cases. First cases, where an asset is used for scientific research, it is brought into my business. Okay, initially, I used an asset for scientific research. I claimed 100% deduction for that scientific research asset. An AC was installed in my laboratory. In AC was installed in my laboratory. I claimed 100% deduction. That AC was later transferred to my office. Okay. So what happens then? We cannot claim depreciation since we have already claimed 100% deduction. But again, since it is brought into business use, we have to add that to the block of asset. We will add that to the block of asset, but the value at which it will be added will be 0. That is actual cost minus deduction allowed earlier. Actual cost is 5 lakh, deduction allowed is also 5 lakh. So the value at which it will be added to our block is 0. Meaning, when an asset used for scientific research is brought into business, its actual cost will be taken as 0. Similarly, when stock in trade is converted into capital asset, then also the fair market value as on the date of conversion will be treated as fair market value on the date of conversion is treated as cost of asset. Okay. When an asset is acquired by gift or inheritance, then the cost of previous owner will be taken as WDV of previous owner will be taken as cost of asset. Now, what I'm talking about now is this explanation regarding explanation code regarding section 43(1). This says, an asset has been transferred and then reacquired. Say, I sold an asset for 5 lakh in July. I sold an asset to Mr. A for 5 lakh in July. I repurchased the asset from Mr. A for 6 lakh in August. Why anybody would do that? Why anyone would do that? Just for the purpose of calculating higher amount of depreciation, is it not? I sold an asset for 5 lakh. I again repurchased it for 6 lakh. If that is done, what will be the cost of asset? Cost of asset will be WDV at the time of original transfer. See what was the original value at the time of transfer, or repurchase price, whichever is less. WDV at the time of original transfer or repurchase price, whichever is less. So we will do a question that is on RTP May 23. It's based on this idea. Mr. A is engaged in the retail trading of toys. He has acquired a motor vehicle on 20/8/21 and put to use on 4/10/22. It was purchased in 21/22 but used only in 22/23. Another vehicle B for 3 lakh on 19/2/22 and put to use on 3/9/22. On 1/4/22, he took a vehicle loan of 5 lakh and acquired a motor vehicle of 5 lakh on 31/5, put to use on 36. 37/23, C was sold for 5.5 lakh and that was reacquired for 6 lakh. Assuming that these are the only assets, what is the total depreciation for previous year 23/24? So there are 3 assets, A, B, and C. Okay, so let us start A, B, and C. Asset A, asset B, and asset C. Okay, we are first in 2021-22. First, we are in 2021-22. 21-22, I think that is the year in which the various assets have been purchased. Asset A is purchased on 28/21. 28/21. Okay. Asset A is purchased on 28/21. So cost on 28/21. That is 4 lakh. B is purchased on 19/2/22. B is purchased on 19/2/22. So cost on same year, 19/2/22. Cost is 3 lakhs. Purchase only in the next year. So now let us total all these. 4 lakh, 3 lakh, 0. Depreciation for 21/22. Depreciation for 21/22 is 0. No depreciation as not used. As not used. See, asset A was used only on 4/10/22. 4/10/22 means 22/23. Similarly, asset B was used only from 3/9/22. That is again 22/23. So there is no depreciation for 21/22. WDV on 1/4/2022. Now on 1/4/22, there is another asset which is purchased. Let us take asset C. Asset C is purchased on 31/5/22. 31/5/22 and put to use on 36/22. But he has taken a loan of 5 lakh on 1/4/22. He has taken a loan of 5 lakh on 1/4/22. Loan taken on 1/4, asset purchased on 31/5 and used only from 36. See, earlier when we discussed the cost of asset, we had explained that anything which is incurred on the asset till the asset is put to use shall be added to cost of asset. So cost of asset C is not just 5 lakh. It is interest paid up to 36. 36 is the date on which it is put to use. 36 is the date on which it is put to use. So interest paid from 1st April to 36, that is April, May, June, 3 months, that is also to be added to cost of asset. So asset purchased on 31/5. 31/5, when you purchase an asset, it's 5 lakh plus 5 lakh into what is rate of interest? 50,000. 50,000 into 3 by 12. 3 divided by 12. That is also to be added to cost of asset. That is also to be added to cost of asset. Interest up to 30th June is also to be added to cost of asset. So when you add both together, you get 5,12,500. Okay. 4 lakh, 3 lakh, 5,12,500. Now we'll charge depreciation for 2000. Depreciation for 2022-23. 22-23. It's 4 lakh into 15%. 3 lakh into 15%. And 5,12,500 into 15%. So what is opening written down value on 1/4/23? 3,40,000. So we'll add all these. Now let us group them together to a block. Total opening written down value is. Now we have reached our year. Our year. Total written down value is 3,40,000 plus 2,55,000 plus 4,35,000. Okay. This is the opening written down value which we get. Now what happened during this year? So we have discussed up to this line. Now what happened during this year? On 30/7/23, same vehicle C was sold for 5.5 lakh and reacquired for 6 lakh. Sold in July, purchased in August. Anyway, we have to add additions. Additions are to be added and sales is to be deducted. Sale has happened for 5,50,000. Is it not? Sale has happened for 5,50,000. Now, regarding additions, let us discuss that theory. What does this say? If you transfer and reacquire, what will be taken as cost of asset? What is taken as additions? WDV at the time of original transfer or repurchase price, whichever is less. When you transferred C, what was its written down value? The written down value of C at the time of transfer was 4,35,625, 4,35,625, or 6 lakh, whichever is lower. Whichever is lower. So what would you take here? 4,35,625 will be taken as value of addition. We cannot take the actual cost of 6 lakh. That is added. What is closing written down value? 3,16,250 into 15% is the rate of depreciation. 1,37,437. Option C will be the answer. Option C is the answer. So this is a question for May 23 RTP. It is slightly different, not like the normal question. So this is how we calculate depreciation. When the asset is sold and then again reacquired, this is how we calculate depreciation. Okay. So we have completed business income also for the day. Next session, we will discuss about capital gains. Okay. Thank you so much.